Welcome to the Daily Bias, welcome to the first video in our strategy course, and I am super excited to get started. I've been trading for over 14 years, but ever since I discovered the Daily Bias, my trading has completely transformed. I have taught this method to a few hundred traders and I've seen great results. I think it's one of the best strategies that you can find out there. It works for Forex and stocks, commodities. I will help you get to know the strategy across all the markets and all the time frames. So let's get started. Grab a piece of paper and let's go. So when you look at a chart, you can see we have a line chart and there's a moving average. What is the one thing that happens all the time? Sometimes sooner, sometimes later, but you can see the market always ranges back around the moving average. You can see that the market always comes back. Sometimes it will take longer, obviously. Sometimes the market will move further away from the moving average, but the market will always touch the moving average. And this is one of the strategy premises. Most markets are mean reverting, especially long term. The mean is the average. Moving averages are the mean, which means that we trade price around a central moving average. This sounds very simple and the strategy is very simple. However, obviously there are a few things that we need to know, and that is why we have this course. So you can see a classic chart. You can see we have trends, we have sideways ranges, we have a trend change. And when we switch to a line graph, we can see, what can you see? Those trends are made up of mini trends and micro trends. So what we have is a macro trend here, and within the macro trend we have micro trends. We have short-term uptrends, short-term downtrends, and in trading we call those waves. We have uptrending waves, or waves that go with the trend, and we have corrective waves that go against the trend. And this is true for all charts. It helps to switch to a line graph every now and then you will be able to follow this rhythm. At first glance, this may seem like chaos and there's not a lot of order, but once you have completed this Daily Bias course, you will be an expert in micro and macro trend analysis, and you will be able to read any chart like a professional. After glancing at the chart for a few seconds, you will be able to know exactly what to do. This is the goal, and trend wave analysis is the cornerstone of all charting tools, of all strategies, of getting to know the charts. It's always starting with trend wave analysis. And as we've seen, the market always moves in waves. The market always goes up and down. That's the one thing that is always true. There's always a back and forth. The buyers and the sellers are always interacting across the markets. And the interaction of the buyers and the sellers, that is causing those trend waves. When there are more buyers, the price will go up. When the buyers withdraw, the price will go down, but it depends on how far the price can go down actually. You can see here a very strong buyer surplus. The buyer surplus faded, but the sellers are not able to completely reverse the price. And trend wave analysis will help us understand corrective waves. We will be able to trade pullbacks. We will be able to trade reversals. So where is the edge? What do we trade? And when we go back to any of our other charts, we were able to categorize the different periods in different chart and trend phases. So you can see we have early trends, we have early pullbacks, we have mid trends, we have mid pullbacks, we have late trends, we have late pullbacks, and then we have a trend reversal. However, a trend reversal will actually become an early trend to the downside. And then we have an early pullback here against the trend. So what are we trading and what is our edge? Where do we make money with the daily bias strategy? This is very important, obviously, to know where's the edge, because that is what we are trading. The edge and the best opportunities exists in early trends. When the trend is just getting started, we are doing trend following trading. We are trading pullbacks, we are trading pullbacks, and we are trading pullbacks. So you can see there's a lot of pullbacks that we are going to trade. However, pullbacks become trends on the lower time frames. As I've said in the beginning, there's a difference between macro and micro. We're going to use multi-time frame analysis. We're going to start on the higher time frames to identify trends and pullbacks, and then we'll go down to the lower time frames to time our trades. So essentially we are trading early trends, we are trading pullbacks. The only thing that we are not trading is late trends. As I've said in the beginning, let's recap. The market and most markets are mean reverting, which means that the market will eventually always come back to the moving average. However, the longer a trend goes on, the higher the likelihood that it will reverse. You can test this on your charts. You can pull up any time frame, any market, and you will see that very long trends are rare. And the longer the trend is going on, the higher the likelihood it is going to reverse. So the only thing that we are not trading is late trend following, which is actually what most of the amateur traders do. Most amateur traders consider themselves trend following, but what they do is they jump on existing trends way too late. And the daily bias strategy helps you avoid one of the common beginner mistakes, and it will help you understand how to find the best opportunities. But this is all just theoretical. Let's go to the next video where I will give you a deeper introduction in how to find the best trades step by step. Welcome to the second lesson, and in this lesson we'll talk about deceleration. Ever since I discovered deceleration, my view on the markets has completely changed, and deceleration is one of the best concepts that we will use in the daily bias strategy. What is deceleration? As the name suggests, it means that the momentum is slowing down. So momentum means how strong the price or the trend is moving. And very often after long trends or at turning points, we will have deceleration. As you see here, deceleration often marks the end of a trend wave. And as we've seen in the first lesson, trend waves are pretty much everything that matters in trading. Trends or ranges, every price move is made up of trend waves. And the better we are able to reach trend waves, the better we will be able to trade, obviously. So we look for deceleration signals on the higher time frames. As you've seen, this is how we discussed how the price moves, obviously in different degrees and variations, but pretty much every trend or every range even is made up of trend waves, correction waves, trend waves, and correction waves. And the best trading opportunities exist at turning points, obviously, because at the turning point, that is where you potentially have the highest reward to risk ratio, because you have the best entry price and you are at the beginning of a new move. So we need to specialize in trading those turning points. And we are going to use a multi-time frame analysis with this approach. The higher time frame gives you the directional bias, which means on the higher time frame you estimate, as we will see later, how are you long, are you short, or better, do you have a bullish or a bearish bias? And here are a few combinations of higher and lower time frames. You can see you can use the monthly as your higher time frame, and then your weekly or the daily become the lower time frame. This is more for the swing traders. In my trading, this is what I mostly use. My daily time frame is the higher time frame, and the lower time frame where I execute the trades are anywhere between the 4-hour and the 30-minute. So it's really nice for different types of traders. If you have a day job and you can't watch your charts all day long, the daily 4-hour combination is perfect. If you have a little bit of more time on your hands, the daily and the 1 hour is a great combination as well, and we will see how to do that. But if you want to become more of a day trader or a short-term swing trader, the 4-hour, 30-minute or the 4-hour, 15-minute combination is also quite popular and works very well in exactly the same way. And we always start by analyzing the higher time frame. That is true for everything that we do, and we will see that across all the trade studies that I've prepared in this course. And at the end of this course, there's a special watchlist video waiting for you where I break down my routine. I show you exactly how I prepare my trading days and how to get ready. So deceleration. There are many different forms of deceleration, and I've picked a few in this video, and also in the next video there are going to be more deceleration examples, because deceleration is one of the most important topics. And if you are able to find good deceleration situations on the higher time frames, trading on the lower time frames will be very easy. So here you can see we are on the daily chart, and the price has first of all been in a downtrend. You can see we have 1, 2, 3, 4 bearish candles in a row, which is already something that should spark your attention, because when you look at a chart, it is rare to see more than 4. You can see we have 1, 2, 3, 4, 5 bullish candles in a row, and then also a reversal. Here we have 4 and a potential reversal. So when you see something like this, that you have multiple consecutive bullish or bearish candles in a row, that should already get your interest, because as we have seen, many markets are mean reverting, and eventually the price will always return to the moving average. So it's really important to understand that the longer a move goes on, the higher the likelihood for reversal. Obviously, this is not enough. We cannot just say, here are 4 or 5 bullish candles, let's go short. That's not enough, obviously. But when you see after such a period of 4 or 5 or 6 or 7 bullish candles, bearish candles in a row, that the momentum is changing. You can see here we have very strong bearish candles. You can see the blue candles are bearish. And you can see we have very strong bearish candles, very weak closes. The price usually closes at the very low, which is a very bearish sign that the market and the participants are able to push the price lower that easily, that quickly. But something is changing here, and those changes are really what matters in price action and momentum analysis. When you see a change in market sentiment, that should really get your attention. Here you can see we go from very strong bearish candles to suddenly a pin bar where the market is struggling to move lower. You can see the price more or less closed exactly where it opened, but at the same time it gave you a rejection candle wick. You can see here the price moved lower, but eventually turned around. And even more interesting, where does it happen? At a previous support level. So now we can slowly have price tell us a story that we are in a downtrend, very strong downtrend, and something is changing here. The buyers or the sellers are suddenly withdrawing. The sellers are suddenly not able to push the price lower below this previous support level. And you can see the price afterwards is stalling. So you can see here we have 1, 2, 3, 4 candles after each other that are showing you the sideways movements. The price is really not very convincingly closing lower or closing higher. And at the same time, you always have those rejection wicks, which are showing you that the price keeps pushing lower intraday, but at the end of the day, the price always closes back above this level. So those are rejections, and rejections are very, very important. Rejections are obviously also deceleration. In this context, you can see strong momentum, and then the price becomes slower and slower, which means decelerating. And this is a trade that I'm currently in. I expect the price to move back higher with this deceleration. Again, in the next 2 videos, we will learn exactly how to time the trades on the lower time frame, so don't worry. This is just the foundation. We need to be able to read the higher time frames. And this is what I keep saying to the students that I've mentored with this strategy. The better you are able to select good higher time frames, the better you are able to find deceleration situations on the higher time frames, the easier it will be for you to execute the trades on the lower time frame. Here again, we are on the higher time frame, the daily chart, and here are multiple scenarios where we have deceleration. So let's take a look at what we have here. So the first circled area around here, can see the market was in a downtrend. We have 1, 2, 3, 4 bearish candles in a row. The price arrives here back at the lows. The price is not very far away from the moving average, which is not really ideal. Ideally, we want to see something like this or here, where the price is really far away from the moving average, because what does it mean? Again, the moving average is giving you the average price over, in this case, 50 periods. We use the 50 period moving average, the simple period moving average. And when the price is very far away from the average, it generally means that it's overextended. It is too expensive because it's very far from the moving average. That's what a moving average tells you. So ideally, you want to find scenarios where the price is far away from the moving average after a strong trend, and then you have deceleration like here. This is also tradable. It's a little bit more advanced, as we will see later, but you can see we go from very strong bearish trend to something is changing here. We have smaller candles, we have rejections. Here we suddenly have a strong bullish candle, and this marks the start of the trend. You can see it happens right at the previous support. This is one thing that it is just, you can't underestimate this importance of those support levels. We will see that later. When you see deceleration after a trend at a support level, that is giving you a very, very strong signal. Then you can see we have a strong bullish run. You can see we have more or less 1, 2, 3, 4, 5, 6, 7 bullish candles here in this trend. Very strong move. There's no correction wave. The price just shoots higher without ever looking back. And whenever I see something like this, I know that many people, especially the amateurs, will jump on it. They will be way too early and they will get burned. But this strategy helps you to stay away from those situations, because you cannot enter unless you have a deceleration candle. So here you can see after those strong bullish candles, the black ones, you suddenly have a doji here, very weak doji. The price more or less opened where it closed. We have a lot of volatility, but you can see this bullish candle obviously shows you that something has changed here in the market and the buyers are not as strong anymore. Then the next candle, exactly the same, weak candle, deceleration, and then the following candle, the market completely collapses. In the later video, when we do the trade timing and I show you how to get into the trades, after this candle has formed, after the first deceleration candle has formed, we will go down to the lower time frames and learn how to time those. And here we have the same thing again. You can see we have a super strong trend, multiple trend waves. You can see here, and you can see we have 1, 2, 3 trend waves here more or less. And then we have 1, 2, 3, 4, 5, 6, 7, 8 bearish candles in a row. And then again, after the price has reached the previous support level, the market slows down. We have inside candles, which mean very small candles that fall inside the range here. And this is deceleration at its best. You can see we have 1, 2, 3, 4 small candles, and then suddenly the market reverses. Again, this is a trade that a few of the students and I also took. And this is deceleration at its best. It is far away from the moving average. There's a super strong trend that has been going on for a while, and then suddenly something changes here. The sellers withdraw right at the previous level. So although it looks like the market is trying to do a breakout, it eventually didn't, and it turned out to be a fake out. So again, great higher time frame daily buyers. Here, another example, crude oil. As I've said, you can use this for Forex, for commodities, for stocks, for indices. I traded across all the markets and it always works very, very well. Obviously, nothing works 100%, but we are here to learn how to spot the best opportunities. So here, what do we have? We have crude oil. Crude oil is in a range market. So you can see we are trading sideways here more or less. And you can see here the market is again far away from the moving average. But more interestingly, you can see here the market is reaching the previous lows. So there's a strong support level in here. And the market, first of all, it seems like the market is trying to overshoot it. This candle is very strong to the downside. However, you can see this is the next candle, an inside candle. This is deceleration. Whenever you see that, especially after a series of strong bearish candles, you suddenly see a doji, an inside candle, a very small candle in general. That is deceleration. And once we have found deceleration, once you've seen this small candle, then you will leave the daily time frame and we will go lower, as we will see in the next video, where we'll do step-by-step trade analyses. But this is deceleration essentially, far away from the moving average. Suddenly the momentum dies down, the market has reached the previous support level, and then the next candle you see, it doesn't get any better than this, a strong rejection here. Those wicks, whenever you see those wicks after or at deceleration, at a previous support and resistance level, that is really where you want to pay attention. And this is a trade that I and also a few other traders took. You can see deceleration at its best, reaching the previous resistance here above those areas. And then suddenly you have a doji candle. You can see we have 1, 2 very strong bullish candles. We are coming from a bullish trend here more or less. You can see it started here with this deceleration candle. And then here afterwards, what happens is the price even sold off more. And those pin bars, in this case, a deceleration candle, showed you exactly the turning point. And this is what happens very, very often across all the markets. Here we have gold now. Gold on the daily time frame was in a strong uptrend. You can see here the market tried to break above the previous trend here, above the previous high more or less, but it failed. You can see we have very strong bullish candle, another strong bullish candle, and then when the market reached the previous high, suddenly something is changing. First we have a doji, then we have another doji, and then the market really, really collapsed. And again, it started with a deceleration far away from the moving average. And then you can see we have 1, 2, 3, 4 bearish candles in a row, very strong. And then something is changing once again. Very strong deceleration. The market has reached the previous bottom. Then it's turning around. Here we have a deceleration candle, an engulfing candle actually, which is giving you the opposite information, that the market is ready to reverse. Very strong bullish candle here, and then the market is back at the moving average. Last example for deceleration, and then we will get into trade assembly, how to pick the best trades with the multi-time frame approach. Here we have 2 examples. Let's start with the classic one. This is what we have learned already. The daily time frame, very strong trend, 1, 2, 3, 4, 5, 6, 7, 8 bullish candles in a row. This is very, very rare to see that many candles in a row, so this should really get your attention, but only after we have the deceleration candle here. This is where we get interested in trading it actually. Just because there are 8 or 9 or 10, or even if there are 100 bullish candles in a row, it doesn't mean that we can automatically go short and reverse the trade. This is not strong enough. This is not how it works. This is what many traders refer to as catching a falling knife. It is not recommended. You don't have enough information, but as soon as you have the deceleration candle, which is this small candle, this is where you drop to the lower time frame, as we will see, and then time the trade and trade it to the downside. But it all starts always on the higher time frame. The doji shows you that something significantly has changed here in how the buyers and the sellers interact. Here, there are only buyers in the market, strong candles. Especially here at the late trend, the market really accelerates, which is something that you can often see before a trend reversal, it looks like the market is really picking up and it's really accelerating. But this is often the case that actually the reversal follows. Usually in the beginning, the trends start very slow, not many people jump on it, but then once it becomes so obvious that there is a trend, all those retail traders, the amateurs, will jump on it. They will only usually get a little bit at the end of the trend. Often they will not be able to pick the top, and then when the market reverses, they're stuck in a losing trade. So this is something that when we think of how the average retail or amateur trader approaches this chart, we can learn quite a bit. That as I said in the beginning, amateurs usually tend to chase the price and they tend to be way too late for trend following trades. And we use this knowledge. We use it. We know there are a lot of people here and there are a lot of people going long. But then here, the doji candle, many people will not pay attention to this doji, but this doji in this context, that far away from the moving average, is a strong signal, and a great trade resulted from that. So deceleration should be clearer by now. What is deceleration in a nutshell? Deceleration is after a strong trend, the price suddenly changes, or the candlestick size and the dynamic changes. It often marks the endpoint of trend waves, and this is how we're going to structure our trades in the next video. We are just getting started and we have learned quite a bit already, and today, or in this video, we will start putting it together. You can see the trade is the topic. So in 3 or 4 steps, I will show you how to find the best trade, and then in the next video, we will learn about stops, targets, trade management, and have even more trade studies step by step. So the first thing is we always need to do the higher time frame trend wave check. You need to make sure that the price is currently in a suitable trend change or trend stage. So what does it mean? It means that the price must be in an early trend, or maybe in a mid-level trend, or maybe you're seeing signs of reversals already. And you also have to make sure the price is a decent distance away from the moving average, and we need deceleration. So step 2 is deceleration. And as we've seen in the last video, usually we get an idea of deceleration based off the last 1 to 3 candles. So dojis, engulfing patterns, pin bars, and those deceleration candles, they help us estimate, are we bullish, are we bearish, or are we not interested at all? And deceleration must always happen at the higher time frame. And ideally you want to see that the deceleration is happening at key levels, which can be support and resistance. It can be significant previous highs and lows, or other traders like to use long-term moving averages as well. So we have a few more deceleration examples, because deceleration is one of the most important concepts of this trading strategy. And as I've said, the better you are at being able to find and select good deceleration charts, the easier it will be for you to trade on the lower time frame then. And here again, we are on gold. On the daily time frame, we are using always the 50 period moving average. I use a simple period moving average, but you also may use the 50 EMA, as we will see later. And what we have here is everything that we need. So you can see the market was in an early trend here, and then here the market really accelerated, and the price is significantly far away from the moving average. Whenever you see something like this, it's not enough to just trade it, obviously, when the price is far away from the moving average, but when the price is far away and then you suddenly have a deceleration candle, in this example an engulfing candle, then you have to really pay attention to this market, and then we go to the lower time frames, as we'll see. But engulfing candles can be deceleration. An engulfing candle pretty much just means that this current candle is completely engulfing the previous candle. So you can see the previous candle falls completely within the range of the current bearish candle, which means that there's significant momentum building up here on the gold chart. Here we have a deceleration candle as an inside pin bar. And again, we have everything that we need. Now we are on the DAX on the 1-day chart. And as I said, you can really use this on all the markets. You can even use it on individual stocks from any stock market from around the world. You just need to make sure that you are applying the deceleration filter effectively. And here you can see we have multiple trend waves. The price is very far away from the moving average. We have 1, 2, 3 very strong consecutive bearish candles in a row, and then something is changing here. First we have an inside candle and then a pin bar. And obviously something significant must have happened here. Here you see a lot of sellers. All the market was just selling. The price on those bearish candles is closing at the lowest low of the candles, which means that the price is really pushing lower. And then suddenly, what is this? Something must have happened here because all the sellers are completely gone and the buyers seem like they're getting ready. Here we have a rejection candle. This pin bar, whenever you see a pin bar as a deceleration candle, those are one of my favorite ones. It's very far away from the moving average, and then you have potentially a nice retest or reversal opportunity, and this is exactly what happens afterwards actually on this one. Here we have a deceleration candle, just momentum divergence or momentum situation. Here we are on the US dollar Hungarian, so you can use it even on the exotic pairs in Forex. You can use it on any stock market around the world, no matter how exotic it is. So we have a trend. You can see the trend has been going on for a while. The price has been above the moving average. It is quite a decent distance away. It's right at the previous high. And this red circle should actually be here because those are the momentum candles. You can see very strong bullish candle, less strong bullish candle, inside candle, and then here a very, very tiny doji. This is deceleration at its best at the previous high where the price has previously shown a bearish reaction. This is very likely to repeat itself again, especially with those nice contacts far away from the moving average, so everything that we need. This is what happens afterwards. You can see a very strong rejection here, and this is what often happens if you see good deceleration at previous levels. The next candle will usually or will often be such a significant drop, which is great for us because we don't have to be in those trades for a long time, and this is a characteristic which is based on the deceleration concept. You can see that here are a lot of buyers in the market and the buyers withdraw. There's still kind of an equilibrium, but you can probably estimate that there's a lot of position building going on. The buyers and the sellers are battling, and once the buyers withdraw, then the sellers are able to really push the price down. Here we have a deceleration candle as a doji, and this time it's not an overextended trend, but this is a retest. So you can see the market was in an uptrend. It reversed, broke below the moving average. Here, by the way, you could have traded this as a deceleration candle higher. And now here we have a retest. So what happens is that the market starts a new trend, it reverses, and then we have a continuation. So we have a start of the downtrend when the market breaks below the 50 moving average. The direction has changed from bullish to bearish. We have the first initial trend wave. We have the first initial pullback, and then with this we are hoping that this level will hold and that the market is actually going to do another trend wave. It continues then the downtrend. And this is exactly what happens. You can see the next candle moved lower, really nice rejection after this doji candle. And this is something that we will see later as well. Those retests early on, as we have seen in the first video, that we trade early trends, early pullbacks. That is exactly what we're doing here. So whenever the market after an initial breakout is coming back to the daily moving average and the previous support level, then you look for deceleration as well, because this is often the start of an early trend. Whereas what we have seen here in the previous examples, those are mostly reversal trades because the market is far away from the moving average, so we trade it back. But here, this is a very different picture. This is where the market is back at the moving average and we're looking to trade retests. Here we have doji number 2 or situation number 2. The market just broke above the moving average, rallied away a little bit. It's pulling back immediately. So now the rationale is that we are looking for a continuation. We believe that this will hold and this is the start for a new uptrend. You can see the market pushed into the moving average, but then here you have a doji, which shows us that the sellers they don't seem really interested in trying to break this level. The market really stopped at the moving average. And our rationale is bullish. We want to see that the market continues. So we have trend wave 1, pullback, and then the next trend wave. And this is what happens, retest at the moving average, and you can see the market accelerated. Now it seems like we may be facing a little bit of opposition here. You can see deceleration is happening, but that's okay. And we are probably already done with our trade since we're timing it on the lower time frame. But again, break and retest on the higher time frames are also quite profitable trading scenarios. And just to summarize a little bit, the goal of the daily buyers and the strategy is really to predict is always a word which is not great in trading, but it's the best that fits here. The goal is that with a higher time frame candle, we are just trying to predict the next higher time frame candle. So what this means is that let's take a look at the first example once again. Here we have deceleration and our rationale is bearish, right? We know the market is far away from the moving average. The trend has been going on. We have a deceleration engulfing candle, which shows a lot of bearish interest. So our goal is, or our prediction is that the next candle will be bearish. Here, our prediction is that the next candle will be bullish, and this will help us finding targets later on as well. Our prediction here is that the next candle will be bearish. Here, our prediction is that the next candle will be bearish as well, and so on and so forth. We are only trying to really predict the next candle on the higher time frame. However, just think about it. When we are on the higher time frame, let's say the daily, that is our higher time frame, and then we go down to the 1 hour to time our trades. On the 1 hour, 1K daily candle obviously are in Forex, for example, 24 candles. But obviously it's much harder to predict 24 candles on its own. But if you have your higher time frame, and the higher time frame, you only need to get one candle right. That is really the thing that sets this strategy apart and this multi-time frame approach. When you don't do a multi-time frame analysis and you just trade, for example, the 1 hour directly, you are usually trying to predict without knowing what happens on the higher time frame, maybe 1 or 2 dozen candles. But if you have your higher time frame and you only trade into the direction of the higher time frame, you only really usually need to have the next candle right, which is making this trading strategy or this approach to trading much, much simpler. Step 3, once we have identified that the market is in a suitable trend stage, we are maybe at the end of a trend wave, maybe we are at the end of a correction wave, at the moving average as a retest, then we go to deceleration. Once we have confirmed that we have a deceleration, then step 3 is we go to the lower time frame and to find a pattern. In the next video, I've prepared just one lesson only on patterns, but in this example, you will already get an idea. So once we're on the lower time frames, we look for price or for candle patterns. Patterns are usually consolidations and they help provide a breakout point. Really important, because the breakout point will be used as our entry. So long story short, again, as I said in the beginning, what time frame you choose as your higher time frame will determine what your lower time frame will be. I use this combination, the daily and the 1 hour usually, sometimes the daily and the 2 hour. And once I have identified that the daily is great and that I have all the criteria that I need on the daily, I will drop down to the 1 hour and look for those patterns. So let's take a look at a few trade examples and multi-time frame analysis. So here we are on the Canadian dollar. This is the daily chart, and the market has been in a strong downtrend, especially the last candle here, reaching the previous lows, very strong bearish candle. We have one pin bar, we have another pin bar, and let's go down to the lower time frame and see how it looks. And first thing you can see is that the price will have a divergence. So if you use an RSI indicator, you will see that although the price seems to be making lower lows here, the RSI will show you that it's making higher lows. Why is that? We don't really need the RSI here when we understand trend waves. Just compare this trend wave to this trend wave. This trend wave is obviously much stronger than this trend wave. This trend wave on the higher time frame is this huge candle. This next small trend wave is the first doji candle. And you can see the next, here we make a higher low even. This is our next pin bar. So when we understand how to put the higher time frame onto the lower time frame, and once we understand how the higher time frame and the lower time frame connect, that will help us a lot. So we can see, okay, we have a divergence. It looks great. The market is slowing down. It's even making a higher low here. It's below the moving average. So let's see what happens. Now we have also resistance level. You can see when we connect the highs, we have a nice pattern. In this example, I think we can safely call this an inverse head and shoulder. It doesn't really matter what you call it. The most important thing is that you are able to find a pattern that has a nice breakout level. As I said here, patterns are consolidations and they help provide breakout points. And in this example, the breakout point is the breakout out of the pattern. And this is what we need. We need to see that the price is closing above the moving average, also on the lower time frame and also outside of the pattern. That is our entry. It sounds more complicated than it is after, and I've prepared like a lot of trade studies. It will become very clear. The only thing that you really need is to see the price break the pattern and the moving average, and that is then our entry theoretically. So this is what happens on the breakout. You can see the price didn't immediately break out. You can see here the price made another dip compared to here, and then the breakout happened afterwards. This is where the price really broke the pattern. This is where the price broke the moving average. This would have been your entry. In the later video, I will show you exactly how to place your stop loss and your target as well. But this technically would be your entry on the lower time frames. And this is then what happens afterwards. The price moved back into the higher time frame moving average. You can see the price dipped back into the daily moving average even here. You can see this is our deceleration, and then we are only trying to predict the next daily candle. And you can see the next daily candle would have been a huge bullish move. So this is what the daily bias is about. And I've prepared many trade studies in the next 2 videos, and it will become all much clearer. Step 3.1, the lower time retest. Not always will you be able to trade the actual breakout, and not always will the breakout succeed. That is really important, but very often we will get a second chance. A retest often occurs after a breakout. This is how it looks. We have a breakout. Here you can see we have a nice double or triple top. We have a good pattern, you have resistance turning into support, the market breaks out, and maybe you missed this breakout, maybe the breakout is too strong for you, or maybe it happens during a time where you cannot watch your charts, and then you just wait for the market to come back. The market comes back into the moving average, the market comes sometimes back into the breakout level, and this provides us new entry opportunities on the lower time frames immediately. So this is what we are looking for. We have a pattern, we have a breakout level, and if we miss the breakout level for whatever reason, or some people are not even comfortable trading breakouts, then the retest may be something to look into as well. And you wait for the price to get there. Like here, another example, you can see the market was trading higher. This is the lower time frame. You have probably a divergence in here. You have a nice pattern. You can see resistance turns into support. Here we have a breakout, and then the retest happens immediately afterwards. We can have different types of retests. Here we have a trend line. You can see that the market breaks the trend line, comes back to it multiple times. Every time you could have added to your position, or just build a new position if you have missed the breakout. And as long as the market really stays below the moving average and the trend line, you're still good to go in the downtrend. And obviously, as you probably estimate, the breakout point and the moving average on the lower time frame will help us with stop loss placement as well. We can, as we will see in a later video, very nicely always protect and tuck our stop loss behind all of those barriers. So we can use those breakout levels, we can use moving averages, we can even use swing highs and lows, as we will see. But this is the great thing about this strategy. Everything fits together perfectly, and we will see that in the next video even further. So before we learn how to place stops and targets, manage our trades, let's do a quick excursion into patterns. So we have learned that the first step is always to go to the higher time frame, make sure that we are in the right trend phase. The next step is that we look for deceleration on the higher time frame as well. And then we drop to the lower time frames and we need to find those patterns. And as I've said in the previous video, the patterns are providing breakout points, and then the breakout point is usually our entry. So it's important to learn how to spot the right patterns. The criteria of a good pattern is that the technical analysis can be applied, which means that the market must be somewhat orderly. You can't have a lot of volatility, the market cannot swing a lot, because then obviously you will not be able to draw perfect or at least near perfect patterns with either horizontal boundaries or diagonal ones. What does it mean? Just let's take a look at the charts and then you will see. So first of all, we have horizontal patterns, and then we will go into diagonal patterns. And we're always going to use that on the lower time frame now. So here we have a horizontal pattern. You can see we have 1 and 2 swing points here. So we have 2 support levels. We have 1, 2, maybe even a triple top, not only a double top. So clearly something is changing. Also, very important, we still use the 50 EMA on the lower time frame, or SMA. You want to make sure that the market hasn't really broken the moving average before the trend change actually comes. So if you see that the market is breaking the moving average, this is what I was referring to previously with you need to make sure the chart is allowing you to provide technical analysis tools. Sometimes the market is really all over the place and you are not able to draw support and resistance levels, and that is not ideal for you or for this way of trading. Here we have the same chart. This is the Aussie Swiss now on the 30-minute. Previously we were on the 1 hour. So the moving average will also help us find the right time frame, because now you can see you have violations of the moving average. So the 30-minute time frame is not the right time frame for trading this market. The 1 hour would be good because you don't have any violation here of the moving average during the whole trend. And what does it mean when the moving average has been violated? It means that the trend correction wave was very deep, or that the market has spent a lot of time moving sideways, which will then give the moving average time to catch up. So this is not ideal. You want to have clean, orderly charts where the trends are not super volatile, where the trends are orderly, and then this is where what you can trade. Another example of a pattern, a horizontal pattern. a double bottom, you can see here we can nicely define the pattern using our support and resistance levels. And also the moving average hasn't been fully broken. This is okay. We have just a spike but not a full close. So the first time the market breaks the moving average is actually after the double bottom and after this pattern has formed. And you can see this is even a fake out. So the market tried to actually break out. It made a lower low, but then shot up higher, which is another very strong bullish signal. Not enough. You need to wait for the breakout, but that is exactly what you're waiting for. Here, another horizontal pattern. Again, the lower time frame, you can see the market in this last trending phase has not broken the moving average here, so it's a good moving average structure. You have a pattern here, you have 1, 2, 3 times that the support is holding, or resistance in this example. You have a head and shoulder pattern. This is the example I think that we looked previously with the divergence in here, where this trend waves become smaller and smaller. Here we even have higher lows. And the first time the moving average breaks is also the break of the pattern. Another example, you can see the moving average has not been broken. Here it's a little bit borderline. Although we have a okay-ish pattern with resistance levels, you can see it's very volatile. This market has a lot of volatility, a lot of strong and long wicks, which for some traders may not be ideal to trade, because it means that there's probably a lot more risk that if you run into such a spike, it will easily hit your stop loss, even if you put it far enough away. So you have to consider, is this a market that you're still willing to trade? And for most traders in the beginning, I would not recommend trading those. I would really recommend focusing on those clean markets. It will make your trading much, much easier. Not something like here where you have seen breaks of the moving average, and also nothing where you have those huge volatility spikes. Let's take a look at another horizontal pattern. Here you can see we are on the 30-minute. The moving average hasn't been broken. So again, the moving average, it's a filter tool as well. It's not only to help us find a breakout. It's also a tool that helps us find the right time frame. You want to see a time frame where the moving average hasn't been broken, and you also want to see a moving average that breaks roughly at the same time with the pattern. Here you can see the pattern is broken here only, but the moving average has been broken here. It's a head and shoulders pattern. It's a great setup. You can see the market made a final push here from here to here, and then immediately afterwards it failed. You can see it made always lower highs. Here the market really stuck to the level. It was not able to push higher at all, which is a very bearish signal. And then the breakout happened, the market really reversed. So the moving average has never been broken. The moving average break happens roughly just a few hours later. We have a head and shoulders here, very strong bearish signal overall. But as I said, we can also use diagonal levels or patterns, which we describe using trend lines. You can see here, I use the trend line describing this triple top or maybe even quadruple top. And you can see the moving average hasn't been broken. In the last trend wave here, it's okay. This was not really a trend. The market has been moving sideways, but when or after the trend has started, the market has not been able to break the moving average just here with the pattern. Here we have another example, diagonal pattern. We have a trend line here. You can see 1, 2, 3 touch points. We have lower highs. The moving average has not really been broken during the trend. We have some nice rejections here actually. And then the break happens very strong. Sometimes the break happens very strong. Not always will you be able to catch the breakout, but there will be plenty of trading opportunities every week with this trading approach. Another diagonal pattern, trend lines are very popular with this trading strategy. You can see we can use the trend lines to really describe the price action. Again, we go from higher highs to lower highs, which is something that is very significant, as we will see later as well. Whenever you see a trend changing with a high and low structure, that is really a significant signal. And then you can see the breakout of the moving average happens with the breakout of the trend line. The market sold off. Initially it struggled a little bit, but you can see we even had a retest pattern in here, and that is what we want. So patterns are really what help us define breakout points, and in the next video I will show you exactly how to time the entry, how to place stops and targets, and also manage the trade. Welcome to the Framework webinar, and we have already made quite a bit of progress. Now in this video I will show you how to put the system together, and in the next video I've prepared many in-depth trade studies where everything will become crystal clear. So when it comes to entries, I think we have covered almost everything already. The entries always happen at the lower time frame. We must have a breakout and we need a momentum candle, which means that the breakout usually happens with a strong candle. You don't want to see that the market is just crawling over your breakout point. You really want to make sure that the breakout happens with a strong candle. And one of the most important things is you always need to wait for the candle to fully open or close. The problem that many amateur traders have is that they make mid-candle decisions, which is when they see a breakout but the candle is still forming, then they jump on it and then they often run into fake outs. So you really want to make sure that you only make your trading decisions when the candle is actually closing. When it comes to stops, as I said already, when we are on the lower time frames where we execute our trades, we can protect our stop loss, which is the great thing about this trading strategy. And you can really decide for yourself how conservative or how aggressive do you want to be. First of all, as we have seen, you always need to wait for the market to break your pattern. You always make sure that the market has broken the moving average, and then you have options. Do you just place your stop loss above the moving average? Do you place it above the moving average and also the trend line? Or when you have a diagonal or a horizontal pattern, then above the support and resistance level? Or do you even go so far and put it above the highs and the lows? Obviously, the further away the stop loss is, the lower your reward to risk ratio, but also the less likely the market will jump into your stop loss. So there's a little bit of a trade-off. In my trading, what I do is I usually place the stop loss not above the highs and the lows, but just above the moving average, and also here above the breakout level. And in the next videos, I will show you all the trade studies with exact stops and entries and all of that stuff. The target is very, very simple. When it comes to targets, usually what you can do is that you trade it back to the moving average. And as we have seen in the first 2 or 3 videos, we are often trading those overextended trends back to the moving average as a reversal. So here you can see this is the same example as in the previous case. It's the US dollar Hungarian. The trade was taken on a 2-hour. The higher time frame is the daily time frame. And you can choose now how aggressive do you want to be with your target. Do you trade it back to the daily 50 moving average, which is probably going to be much, much further, as we can see here. Here's the daily. You can see the market would have eventually reached your target, but you can see there was a big spike. So trading it all the way back to the daily time frame will obviously give you a much, much greater reward to risk ratio, but it will also mean that you are staying in the trade longer and you have a higher risk of actually getting taken out during the trade duration. And it's also emotionally much more challenging to have a longer holding time. Another thing is that many traders that I have mentored, what they ended up doing is that they find a compromise. When you have your daily time frame as your higher time frame, the 2-hour or the 1-hour as your time frame where you enter the trade, then you go to the 4-hour, to the next higher time frame, and you trade it back to the moving average, for example. This will give you a much closer target compared to the daily, but it's still often reasonably far away for you to get a good reward to risk ratio. Again, there's no right or wrong in my trading, but I have more experience and I don't mind having a longer holding time and a lower win rate. I trade it back to the daily, but what I often see in my students in the beginning is that they feel much more comfortable trading it back to a lower time frame moving average, for example, the 4-hour. They are in and out of the trade quicker, you have a higher win rate, you build your confidence faster, although your winners are not as big in the beginning, but building confidence in the beginning is much more important. Another thing to really consider when it comes to targets is, are you trading with the trend or against the trend? As we have seen here, there are with the trend plays, there are pullbacks, then those are the retests, and with the trend, against the trend. With the trend waves usually go much further. This means your targets can be much wider. If you are just trading a pullback, your targets should be way shorter, because this is what the Dow theory many decades ago already confirmed, that the price moves in those trend waves, uptrends or trend waves and correction waves. The trend waves are longer, the correction waves are shorter. So it really matters that you understand, are you in a reversal trade or are you in a pullback trade or in a trend continuation trade? And obviously the reward to risk ratio is a result based on your stop loss and your target. And in my trading, I keep it very simple. I don't need to make it more complicated than it needs to be. I choose only trades where I have a minimum reward to risk ratio of 2-to-1. And if I, for example, have a trade that I want to trade back to the 4-hour 50 period moving average, but I only get a reward to risk ratio of maybe 1.5 2-1 or maybe only 1-1, I will skip the trade. And this is very important. There will be trades where everything lines up perfectly, the higher time frame is great, the lower time frame is great, but you are not going to get a great reward to risk ratio. And you cannot trade those markets. This is very difficult for new traders because you always want to trade, but the reward to risk ratio is directly impacting the profitability of your system. If you trade trades with a low reward to risk ratio, your winners will be very, very small and the losses will quickly eat up your profit. So it's much easier to trade with higher reward to risk ratios. You don't need to have reward to risk ratio of 4, 5, 6-1, but trading above 2-1 is already a good start. Trade management, I am mostly using a passive approach, which means that I don't really manage my trade after I've entered. I just place my stop loss and my target, and then I let price do its thing. I wait until either my stop loss or my target get hit. However, there are ways how you can also approach it, which is what I sometimes do when I have very long trades, where I have maybe a trend trade and I expect to be in the trade for a long time. I will trail the stop loss behind the 50 moving average, which gives you a good protection. The 50 period moving average usually moves slow, which means that you are not pulling your stop loss too fast, which is something that many amateur traders do incorrectly. They always suffocate their trades and they don't give it enough room to breathe. But using the 50 period moving average on your trading stop loss can work very well. And obviously, we need to also talk about news. News are less impactful on the higher time frames. So if you trade, for example, a combination of the monthly and the daily, which works very, very well on individual stocks. Individual news items obviously have less an impact on the daily or the weekly time frame. But if you trade, for example, the 4-hour and the 30-minute or the 4-hour and the 50-minute, news can really shake up your price action and there can be a lot of volatility. So if you are trading on the lower time frames, it's not advisable to trade 30-minute before a news event. So if you see that a new news event is coming up and you're about to take a trade, it's better to usually skip it on the lower time frames. And if you are in the trade already on the lower time frame and a news event is coming up, you have to choose if you want to close the trade and secure your profits, or you want to trail your stop loss and minimize the potential loss. However, there can always be the chance that the market is just gapping against you, but this is usually not rare, but it's one of those risks that you need to consider. And what are you going to do with the weekend? On the lower time frames, if you trade, for example, the 2-hour or maybe the 1-hour, I would always recommend to close the trade. But if you're trading the higher time frames, then you need to understand that the holding time will be longer and you have to hold trades over the weekend. If you trade, for example, the weekly and the daily combination or the monthly and the daily, you will have to hold trades over the weekend because the trades won't be over as quickly. So the time frame choice also depends how news and the weekend trading will impact you. So this also needs to be into consideration when you choose your time frames. That is why in my trading I use the daily and the 1-hour very often, or the daily and the 2-hour. You are not as impacted on news, but your holding time is also not as high. So on the 1-hour, you can often be in and out of the trade within a day because we are only trying to predict the higher time frame candle on the daily time frame. So you're not going to have a very, very long holding time, and that needs to go into your consideration as well, which is why I would recommend for Forex traders or for new traders, a combination of maybe the daily and the 2-hour, the daily and the 1-hour. If you're looking for trading stocks, for example, individual stocks especially work very well on the weekly daily or the monthly daily combination. All right, now you have a very, very decent and deep understanding of how to put the things together. And in this video, that is exactly what we're going to do. I've prepared in-depth trade studies, step-by-step, higher time frame to the lower time frame, from the daily bias to the exit, and everything else that you need. So get a piece, a pen of paper, and let's get started. So the first trade, US dollar Hungarian, we have talked about this, but I want to analyze it in depth. So you can see the market is in an uptrend. It has been trading above the moving average on the daily time frame for quite a while. You can see we are here probably in a mid or late term trend. We have had many multiple bullish trend waves, and especially here now we are in the second wave again, 1, 2. Can see the price is reaching the previous highs, and then the momentum structure has changed. We go from very, very strong bullish candles to less strong, and then we have 2 dojis. And this is the daily bias. If you find something like this, even on the first small candle, this would be enough to go to the lower time frame. It's far away from the moving average, and let's see how it looks on the lower time frame. So this is what we have. Now we're on the 2 hours. So as I said, if you're using TradingView allows you to use custom timeframes, and a 2 hour works very, very well. You can also, of course, use the 1 hour or the 4 hour. And here you can see we have a triangle pattern. We can draw trend line describing the lows. We can see the highs are coming down actually, which is a very strong, or not a super strong, but it's at least a start for a bearish signal. Can see the market, whereas previously it was always able to make higher highs very quickly. Now it failed and you have multiple lower highs here at this high. All right, what else do we need? We need now, our trading plan is that we need to wait for the breakout of the trend line, the breakout below the moving average. And only if this happens, we are gonna get into the trade. Even if you have the best situation on the higher time frame, it doesn't automatically mean that you can get into a trade. You need to make sure that you're going with the momentum on the lower time frames. That is very, very important. As you've seen in the first videos, we are focusing on trading those turning points where trend waves are ending. And we are not trying to pick an absolute top or bottom. We are going with the momentum. So trading in those ranges and in those patterns is not recommended. And you need to make sure for the market to really break out. And this is what happens. This is the entry candle or potential entry candle. The breakout happens strong. The momentum candle is quite decent. It's a good size. There's not a lot of volatility. It breaks the moving average. It breaks the trend line. And this could have been your entry point. The stop loss, you have many, many options for the stop loss. You want to put it above the moving average, probably also above the trend line. It's not necessary to put it that high, but the stop loss can be very nicely protected. And the protection of the stop loss is important, obviously. This is what happens afterwards. You can see very nicely the market, in this example, it never looked back. The trend really emerged here after and really accelerated after the breakout. And this is what we've seen. This is what often happens on those great daily time frame biases. There's a lot of pressure building up on the higher time frame. When you see that you're going from a very large candle to small candle, there's a lot of pressure building. And once the breakout happens, you will often see that this breakout is really exploding with momentum. Again, let's take a look at the higher time frame after the next daily candle. So this was the daily bias. Then you can see the next candle really exploded, but the market hasn't reached your daily time frame moving average yet. So as I said in the beginning, targeting the daily 50 moving average is probably going to give you a very wide target, so a higher reward to risk ratio, but you will have to stay in the trade longer. Whereas you could just go on the 4 hour and you are already in and out of the trade. So again, the target of the daily time frame is usually a little bit too far for most traders because you are stuck in trades for too long. But having like a compromise between a higher and the lower time frame, in this example the 4 hour 50, would work very well as a target, and you are in and out of the trade very quickly. The second trade, we are looking here at gold, the daily chart. We have taken a look at this situation on the higher time frames already, but we have never seen what happens afterwards. So the higher time frame, the price is very, very overextended here, very far away from the moving average, and then suddenly we have an engulfing candle. Whenever I see this, I would go to the lower time frame and see what does it look there. You can see we don't have a pattern yet. The market is at the moving average, but we don't have enough swing points yet to call it a pattern. We have this here, but that's it. We have nothing else. We have maybe one small support or resistance here. And my trading plan would look something like this. You want to see that the market is making a pattern. It is really confirming here that the level is strong, and you can see if the market pulls away and gives you this breakout, then this would give us also a lower high, and it would show much, much more bearishness. So this is what happens after a few candles. You can see the market made a significantly lower high. It didn't break the moving average right away. And then here was the breakout. Very good breakout, cleared the lows. Now you can really see that, okay, now there is a level. Compare it to what happened here. Now, here we don't have a level. You just have maybe a potential level building, but we don't have enough support and resistance touch points here. We only have it here when the market is actually confirming, yes, there is a level, and then you can time your breakout here. So this is what happens afterwards. You can see after the breakout, the trend really accelerated to the downside. And again, don't be early. This is what many traders will make wrong. As I said, mid-candle decisions have to be avoided. There will be many fake outs. and you need to make sure that the price is really closing outside of your pattern and below the breakout point. This is how it looks on the higher time frames. On the daily, you can see was our daily bias with the engulfing candle, then this little doji, which is the candle that on the lower time frames is where the price stayed above the pattern, and then the next candle really accelerated to the downside. The price has never reached the daily moving average, but here after the huge candle to the downside, you can see we have a deceleration candle again. And this doji would mean an exit for the trade if you are not already out based on the lower time frame. So when you see that on the higher time frame, you have an opposite bias candle. So you have your bearish bias here, and then you have a bullish bias here, then you need to get out of your trade. That could also mean an exit if you are not already out based on your target. Setup number 3. Now we are on Apple. You can trade this on individual stocks as well. You have very overextended trend. The trend has been going on for a while. The market is very far away from the moving average, and you have a huge engulfing candle here as your deceleration candle. And what does it look on the lower time frame? Here we have a nice trend line. The moving average has not really been broken, only once, but that's okay. We have a decent trend line. We have a good level in here. Previous resistance is turning into support. And you can see this is the engulfing candle at the top. It really looks like if you look for a bump and run pattern or for a boom and bust pattern, this is usually what you will find. An initial gap up and then an immediate collapse. Obviously, this is a very bearish signal, but not enough to get into the trade. We need to make sure that the market is breaking out of the structure. This is the trading plan that we need. And it helps to draw it out on your charts, which I will show you in the next videos when we do the watch list and the trading plans together in a live market. So this is the trading plan. We need to make sure the market is closing below the level. You can see here there's a high likelihood for a fake out, which we never make mid-candle entry decisions. You will often run into those things. You need to wait for the market to clear the level and to close fully outside of it. This is what happens. You have a gap breakout. You can see the market opened or closed here, it opened then here below the breakout point, and this could have been your entry. Where do you put your stop loss in this example? Above the breakout area for sure, above the trend line as well. So your stop loss could very safely be tucked here. You could also think about adding it above the last swing point around here. That would also be acceptable. And this is what happens afterwards. The trend really accelerated once again, and those are obviously hand-picked setups. But this is what we're going to do in our live trading as well. We are only going to trade the best daily time frame in combination with the best lower time frame. And that is why you will often end up with those very nice trends that just explode on you. You can see this is the higher time frame here. Eventually the market made it back to the moving average, but it took a lot of time to get there. So if you really trade the daily time frame target, you will have to stay in your trades for a long time. And that's why I keep suggesting maybe a compromise, and maybe the 4-hour would be a better choice. And let's take a look at setup number 4. Here we are looking now at a German stock. This is BMW. So you can see we can trade it on stocks, on Forex, on commodities. We can trade on indices, and you can even use it on cryptocurrencies. It works really well on Bitcoin as well and other cryptos. So what do we have here? The market is in an uptrend, quite a distance away from the moving average. You can see a very strong bullish run here. It also hit the upper ceiling of this channel. And you can see we have a doji candle, so we have deceleration here. Let's see how it looks on the lower time frames. This is what we have. We have a divergence. In this example, I added the RSI just for visual confirmation. You can see the RSI made lower highs, the price made higher lows. That's a divergence. It means that the trend waves are getting shorter, and we can see that just looking at the chart. Compare this trend wave to this trend wave to this trend wave. Subsequently, trend waves getting shorter and shorter into the top. That should really get your attention, especially because this is also the daily bias inside candle. And we have a very decent level. You can see resistance turning into support. The moving average is meeting us here. So our trading plan, as you have guessed it, would be either a breakout, a break in a retest, or maybe even something like this. It doesn't have to automatically break immediately, but it can also be that you get another point. and it really helps you draw out the potential scenarios on your charts. I will show you that in the next video when we do our watch list together. So let's see. The breakout happened shortly after. You can see that here we have a double bottom, a double top here. Our stop loss in this example, we will probably place it above the level here. There's no need to place it above the all-time or above the highs here, but I would also not recommend to place the stop loss right above this area. I would recommend place the stop loss here in the middle between the highs and the lows. If you place your stop loss right here, the problem is that you will often see a retest take you out your stop loss. That's not really good. So you want to make sure that even if a deeper retest happens, you're not as vulnerable for stop runs. And this is what happens afterwards. You can see that is why I said don't place your stop loss too close. The market did make a retest here. If your stop loss is too close, you would be taken out, and if not, you could have ridden it out. Obviously, this is not a very strong trend initially, and then you kind of get lucky, maybe not. In the long term, if you stick to the plan, the odds will play out. This is exactly what the strategy is trying to find. It's trying to find those tops, those turning points, or those end points of our swing points, and that's usually where you see the biggest push and the most momentum. You can see on the daily time frame the market. Again, it would have taken quite a while for the market to reach the daily time frame, but it eventually did. So again, the daily time frame means longer holding time. It's usually difficult or more difficult to trade. It is better for your reward to risk ratio, but in the beginning I would really recommend to use a smaller target, maybe the 4 hour, or trail the stop loss behind your moving average. And with more experience, when you have more confidence in the setup, when you understand the strategy better, then you may choose to go to the higher time frame if this is something that you actually prefer. In the next video, I will show you step by step how I perform my weekly and my daily preparation, how I map out my trades and how I plan my trades with my top-down approach. But before that, I want to give you another quick lesson which will help you understand what to do with the system and how to really make it personal. Because in the end, the best traders that I have seen emerge from our mentoring are the ones that first of all follow the rules that we provide them, but then think about how can they add things or subtract things or change things to make it fit their own thinking. And adding indicators is just one example. You can obviously change so many parameters of the strategy. As I said, you could choose to use the daily time frame target, maybe the 4 hour, you could choose to trail your stop loss. So there are a few things that are totally under your control that you can use to make it really fit your own circumstances and your conditions. And indicators are certainly also one part. And I will show you how to use them in a creative way. So the first thing that we could do on the lower time frame is we add a channel of moving averages. So you can see I have 2 moving averages, EMA 5 periods. One is applied to the high, one is applied to the low, and then you will see such a channel. And what the channel is often helpful for is staying in trades. So you can see we have our nice pattern here, we have a nice breakout, and then as long as the market is not trading outside or on the opposite side of the channel, you can use the channel to write your trades. And when the price is actually breaking the channel to the opposite side, then it would mean a trade exit. So this is one way how you could use the channels. Here's another example. We have a breakout pattern here that we have looked previously. This is gold. In the last video, you can see this is our entry or potential entry. And you can see the moving average channel would have helped you to ride those trends for a long time with more confidence. Also, a Bollinger Band could help as well. The Bollinger Bands, especially the outer Bollinger Bands, will help you understand when a market is really overextended. You can also choose to set the Bollinger Bands to maybe 2.5 standard deviations, which will make them a little bit wider. And when the market is hitting the outer Bollinger Bands and giving you a deceleration signal, then you would look for the lower time frames. And you would filter out signals, for example, like here, where the market is not close enough to the outer Bollinger Bands. Even if there's a great daily bias, it's not worth trading. Or here, it means that it's not overextended enough. So Bollinger Bands may also be used as an additional filter. Here, another example, the US dollar Hungarian that we looked at previously, it reached the outer Bollinger Band. You can see this market moved from one side of the Bollinger Band to the other, very strong trend wave, and then you can see here a strong deceleration signal with this engulfing candle and the pin bar before that. And another thing that I already touched upon is that I said during the video that I use mostly the 50 SMA. However, I have seen other traders use the 50 EMA instead. And there's nothing wrong or right about EMA or SMA. There's not one is better than the other. Sometimes the EMA will work better. Other times the SMA will work better. Over the long term, the only thing that really matters is that you are consistent. So choose a moving average and stick to it for at least 20 to 30 trades. And then maybe choose another moving average, stick to it for 30 to 40 trades, and then evaluate what do you feel more comfortable with, where do you see your edge, and then you can decide, okay, what works better for you. Here again, EMA versus SMA, you can see they move very differently at times. Sometimes they're together, but you can see sometimes you get a retest from the EMA, sometimes you'll get a retest from the SMA. Again, different moving averages will give you different signals. Sometimes the EMA will give you a signal where the SMA is giving you not a signal, or the other way around. Over the long term, in my experience, there's not one better or worse tool. It will always average itself out. Another very interesting use case is maybe using a stochastic for timing your overextended trade. So you can see when the market or when the stochastic is in an overbought or oversold condition, it usually points towards a market that is very strong and has been going on for quite a while. And you can use the stochastic or even the RSI. You can change the settings around to see how does it work for you for finding overextended trends or trades based on the stochastic. And what I've seen usually is that many traders, they start with indicators, and then after they see how the indicators behave, they will learn how to read the indicator even without seeing it. We have seen in a previous video that we can understand how to read a divergence from your charts even without an indicator when we just look at the trend wave length. And this is true what happens with most indicators. There are great confirmation tools to help you stay objective in the beginning. And then once you have more experience, what I see is that most traders take off the indicators because they exactly know how the indicator would behave in any situation. Again, those are not all the possibilities. You can use different indicators, different settings for different purposes. The goal of this video is really just to provide you with some inspiration of how you could alter different tools and features of this approach to make it more yours. So I prepared a few trade studies completely top down with a daily bias approach. And the goal is that we're going to take a look at, I think, four trades, step by step. Higher time frame to lower time frame. Higher time frame, we want to get the direction. Lower time frame, we want to time our entries. So stops. When it comes to stops, and we're also obviously going to talk about entries, very precise, how to get into trades. But stops, the rules are that obviously stops, the goal of a stop is that it helps you to protect your trade idea. And also they control the win rate to some degree, obviously. Closer stops means that the price has an easier time to reach your stops. Wider stops will mean that the price will have a harder time reaching it. So the win rate usually goes up. Your reward to risk ratio usually goes down. And the rule for stop loss placement that I am using is that I want to place my stop loss behind at least 2 technical barriers. And those, as we will see, can be horizontal breakout levels, so support and resistance. It can be a trend line or our 50-period moving average. And when it comes to targets, targets must be reachable. The problem that I see with many amateur and new traders is that they place their targets very optimistic and usually or very often just too far away. And then what happens is that your win rate will go down because the further your target away, the lower or the harder it is for the price to reach it. And also, obviously, the closer your target, the easier it is to reach it and the higher your win rate. And in the beginning, if you are a new trader just starting out, or if you are struggling, the focus should not be on making or trying to make a lot of money in a short period of time. In the beginning, if you're starting with a new system, especially, the goal should be to just build confidence in your skills in the system. So in the beginning, I would always recommend to choose your targets a little bit closer than you would usually, just because you will have more frequent winners, and that will be a much much more helpful for your overall confidence. And then once you get better, once you're building confidence, once you have experience, then you can slowly work on extending your targets. And we will talk about that as well in the trade studies. And when it comes to trade management, here are my 5 rules. So they can be obviously changed a little bit, make it fit to your own needs. But when the price moves 50% towards my target, I will move my stop loss to break even or close to break even. So let's assume we have a trade where with a 2-to-1 reward to risk ratio. And when the price has moved in our favor, maybe it's halfway, it's at the 1-to-1 reward to risk ratio threshold, we can move our stop loss a little bit closer to just reduce the risk. When I trail my stop loss behind the 50-period moving average as well. So if a trade takes longer to develop, you may then also start trailing the stop behind the 50. If the price has not moved away from the entry after 3, 4, or 5 candles, I will close the trade or close it partially. So this means that because the daily bias at its core on the lower time frames, it's a breakout trading strategy, obviously, as we will see and as we have seen. And what you want to see is that you take an entry, and your entry is usually based on a high momentum breakout. And the last thing that you want to see after a high momentum breakout is that there's no follow through. So those inactive breakouts where the market is just not going anywhere, it is best to just reduce your risk and take maybe 50% off the trade. And when high impact news are coming up or about to be released, close the trade partially or trail a stop loss to break even. And one more thing is, if the high impact news is coming out, but let's assume the price is already very close to your target. So if, for example, you have a trade with a 2-to-1 reward to risk ratio, and the price is already like at 1.8 or 1.7, the additional profit potential is just so small that it usually doesn't make sense to accept the additional and the huge risk that can often come with a high impact news releasement. So if the price is already very close to your target and you see that the news is coming out, then it's usually better to just close the trade and secure the profits. When the weekend close is coming up, I will also close my trade if the price is close to my target or close to the entry. So if the price is still hovering just around my entry and the weekend is coming up, I'm not going to take the chance that the market will gap against me on Monday morning and just have me started on a bad foot on the week. That is not a good way to start the week. And if we can mitigate the risk by just closing out the trade and starting fresh, that is also usually preferred. All right, so let's take a look at the exact trade studies that I've prepared. And we're also always going to start with a higher time frame. And as I've mentioned already, when you trade the daily bias, you have usually multiple choices. So the general approach for a swing trading strategy is that your higher time frame will be the daily, and then usually your executional time frames will usually be somewhere between the 4-hour and the 1 hour. And another opportunity and another option would be that your higher time frame is the 4-hour, but you execute then your trades on the lower time frames all the way until the 30-minute or even the 15-minute. And you can choose the approach that makes sense to you, and based on how many trades you want, how good are you with patience, and what fits your current situation. All right, so here we are on a higher time frame, and as always, we want to look for markets that have been trending for a long time on the higher time frame, and that are reaching previous support and resistance areas, and also that shows signs of slowing of momentum, some type of deceleration. Deceleration, as we've talked about, can be pin bars, they can be dojis, they can be inside bars or engulfing bars. So here we have a kind of a pin bar, but with a very strong bearish close. So you can see we have a strong rejection above the previous high that we've drawn here. And the market pulled away already quite a bit. So after this candle has been formed, we drop to the lower time frame. And here on the 30-minute time frame, you can see we have a very nice, well-defined trend line. The trend line needs 3 touch points, as we've learned, 1, 2, and a third touch point. And then also we want to trade obviously only short when the market is below the moving average, when it's breaking the trend line, and when it has been broken the previous low. So this is a way of staying away from picking absolute tops and absolute bottoms. And this is then obviously our trade entry filter. So we want to really make sure that the market is making also a lower low at this point. So when the market is breaking this area, we have on the lower time frame shifted from higher highs and higher lows to then lower lows. And this is a very important signal when it comes to general trend theory. So here, this is how it looks, a very strong move here on the price on the lower time frames and very strong breakout. And you want to make sure that the market is really breaking out below the last swing low with a strong momentum breakout. What you don't want to see is the market just crawling beyond or through the level. That's usually not what we want to trade. We want to see that the market is really actively breaking the level. And the stop loss rule, as I mentioned here, we want to tug away the stop loss behind at least two technical barriers, which we have here. The first barrier is our last swing low and also the trend line here. And this line is, you cannot see it. Now you can see it's the daily 50 period moving average. You can use an EMA or an SMA, that's totally up to you. Both will work quite well and equally well. And you can see that we can use the daily as our target, for example. So this is roughly a 2-to-1 reward to risk ratio, which is not too large, which is a good place to start out with. As I said here, we want to make sure that we chose targets that are very close or closer than you usually would. So this makes for a decent target that has that makes sense in a chart context as well. What you don't want to do is place your target just a little bit below that, because obviously there's a huge risk that the market may bounce off the 50 on a daily, and you don't want to take that risk. So this is a trade study, and you can see the market actually did bounce here quite a bit off the daily, and you don't want to be in a trade where you have your target somewhere here, it's not reached by just a few points, and then you suddenly are faced with a huge drawdown and you don't know what to do anymore. So a very, very quick trade for this one. Second example, now we use the higher time frame as our daily time frame, whereas previously it was the 4-hour. And this is another example. So whereas this trade was a pullback on the higher time frame into the 50 period moving average, now we are looking for a pullback away from the moving average. So here the market is in a long uptrend and obviously all the way above the moving average. And we have seen the moving average held previously, which is a good sign already. And you then see and you look for deceleration at a moving average. This is very important. You always want to make sure that your higher time frame has already some sign of deceleration. And then we drop lower to the lower time frame. In this case, we have a 1-hour time frame. We use our moving average here on the lower time frame to help us understand, is this a market that has moderate volatility? What you don't want to see is that the market is constantly breaking through the moving average. That should be avoided, especially when you're using a horizontal level. When you use a trend line like we did here, it is okay to see a few violations of the moving average, but you don't want to see a lot. And especially you don't want to see violations when you use a horizontal pattern. And you can see we have some type of a short-term trend line. We have a resistance level here that has multiple touch points. We already have, if the market turns around, we have something that looks like an inverse head and shoulder with here the spiky head. And the breakout or the entry signal would be given when the market crosses above this threshold, which happened here. You can see previously the market made a bullish attempt, and this close here on the bullish candle, I would not consider this a high momentum breakout, obviously, because although the market may have broken above the previous high, it's just barely, and there was a lot of rejection here. So you don't want to get in when you see a lot of rejections already with a candlestick wick, and when the breakout is not decisively closing above the level. And then for stop loss placement, you place your stop loss, as mentioned, behind two technical barriers. And this is the resistance level, and it's also the moving average. Two levels of protection for our stop loss, and then we can choose a 2-to-1 reward to risk ratio, and then this is how you would play it out. You can see moving a stop loss to break even would have been an option, so the market hit the 50% roughly around here, and you could have moved your stop loss behind the breakout level, and then you could have also trailed it along the moving average as the price then continue to move higher. What you don't want to do is be too aggressive with your stop loss movement. That is something that many traders and amateur traders make as a mistake, is that they end up suffocating their trades. They're just too aggressive. They move the stop loss too close behind the current price, and then they will easily be taken out. But as long as the trend structure is still holding of higher highs and higher lows, and as long as the moving average hasn't been broken, the breakout trades are usually still good. Here, another example where the higher time frame is the daily one, and you can see the market was in a strong downtrend, multiple trend waves here below the moving average, a fairly good distance away from the moving average. And now we have a doji, and then here another doji. Here we also had a little bit of an inside bar. You may have taken this trade. This would have ended up as a losing trade, and it's very, very important to understand that it won't work 100%. Nothing works 100%. That's why we use stops, and that's why we need to adhere to our stops. And that is very important. So let's assume we are now, from this example, going to a lower time frame, and this is a trade that I actually took. You can see we have on the 4-hour time frame here, we are looking for a trend line 1, 2. I would not count this as a trend line touch because the market obviously didn't pay any attention to the trend line. So we have 1, 2, 3, 4, and then here a 5th. So this is a very strong trend line. We can see the moving average is just being respected, and we have everything, all the breakout clusters or all the breakout levels we have in one area, which is great because it means that if the price is really able to break above it, it's a meaningful breakout. So let's see. This is how it happened. This is the trade that I got in as well. And this is the higher time frame. This is the daily time frame moving average here, this red line. And choosing this would give you a 5-to-1. Obviously, in the beginning, I would maybe suggest choose a 2-to-1 reward to risk ratio. The stop loss is tucked behind all of those 3 levels, which is great because they're so close together. So they will act as a nice resistance. And you can see the market came back very close to the entry. But if you use a trailing stop loss behind the moving average, your stop loss or your trade is very nicely protected. So trailing a stop loss not too aggressively is actually something that is very, very important. Here, another example, now the higher time frame, once again, the daily. And here we have a 2-day pin bar, or we have 2 pin bars over 2 days. And those are very strong signals. I keep tracking them in my journal as well. And if you see 2 consecutive pin bars in a market that has been trending for a long time, that is often a great, great deceleration setup or signal. So this is how the 2 pin bars, or how it looks on the lower time frames after the 2 pin bars have been formed. You can see we have a very nice structure above the moving average. We have a trend line 1, 2, 3, 4 touch points. Here's the last swing low. So we want to make sure that we are really below the last low, because what does it mean? If the market breaks out below this low, it means that we haven't made a higher high. We have made a double top more or less. And on a breakout, we have now made, or the price, not we, the price has made a lower low. So a complete trend change, a very, very strong, important signal. And again, this candle here, I would not consider this a breakout candle, the little pin bar doji thing, because we really want to see the market actively pulling away from the level. So I would always give my trade a little bit longer and one more candle to see if the market is actually pulling away. And in this case, you can see if you target the higher time frame moving average, that would have given you a 4-to-1. But as I said in the beginning, I would probably always choose a 2-to-1 reward to risk ratio, just because it will give you a much higher win rate and it will help you build your confidence much quicker. And you can see this is the current situation. I haven't updated it yet. This was taken like a few hours ago. So this is how it currently looked. Again, the market came back into your entry, but it never really challenged the breakout level, and it never even came close to our entry or to our moving average. So our stop loss is very nicely protected, and this is giving our trade a lot of room here to unfold. Another example. This time we are on the 4-hour on the higher time frame, a huge downtrend. You can see multiple waves to the downside, and then here the market started rounding off. You can see we have a pin bar, we have a small bearish candle, another not an inside bar, but a small candle, then here a doji and another doji. So let's see how this looks on the lower time frames. And here again, very important, we have a great moving average structure. So this is the higher time frame is the 4 hour, and then we have our lower time frame as usually something between the 15 and the 30 minute. And here you can see we have two breakout levels on top of each other. And the rule that I use for a market like this, that if you see that you have two previous swing points on top of each other that are so close, I would always choose the one that is a little bit higher, because if you get in here on a breakout, you risk that the market is immediately bouncing off of that. And it's not too much that you're giving up in terms of getting in too late if you just wait a little bit longer for the market to actually close above the level. And you can see that here, a very strong breakout above the moving average. Here we use the daily as our 2-to-1. The stop loss is tucked away behind all of those areas. So very safe stop loss placement. And you can see a strong breakout and a strong move into the daily 50 and an easy and quick trade. The last example is here. Another one on the higher time frame is the 4 hour. You can see the market was in a long downtrend. And then here we have dojis, we have another red candle, and then two inside bars. And obviously a huge area of consolidation. If you look left, here is also previous resistance, and in here is a demand area. So we have a lot of confluence as well when we look left. And this is how it looked on the lower time frame, the 30 minute. And you can see we have a decent trend line. We have 1, 2, 3 touch points. The moving average hasn't been violated a lot. And you can see here's also the last swing point. So we wait until the market is broken out. But in this example, the market didn't break out for a long time. So here is where we left off. And this was here. The market never broke out above the line that we drew, and the market even kept going lower. And now what we do is we update our levels. We update to a new trend line that is down here, and we also move our breakout level a little bit lower. So this is how it looks then updated. We have a new trend line. The moving average still hasn't been broken a lot, and we have a new resistance level that has been used twice, here and here. And now let's see if we move above and if we break above it. This is how it looked shortly after. You can see the market turned around. We already have a higher low, which is great. And now we have a higher high as well. So a complete trend change. And if you target the daily 50, it gives you 4-to-1. But obviously, if you choose a half of that, it will boost your win rate. And in the beginning, win rates improvement and having a higher win rate is usually what most traders should go for, at least for the first few months, until you have a good feeling for the system. And you can see this is the market that or how it looked when I closed or when I updated this time frame. By now it probably should have moved somewhere. I haven't checked it since. But if you use a 2-to-1, the market would have reached it already. And if you use a 4-to-1, you will probably stay in a trade much longer. And as I said, the longer and the wider your target, the harder it is for the price to reach it. And something that most traders overlook, it also means that your holding time will increase significantly. So a wider target has two negative trade-offs. The first one is your win rate will go down and your holding time will go up. And those are two things that are just very, very challenging for traders. Because obviously what is hard about trading is having having a low win rate and staying in winning trades and riding your winning trades. So by choosing a target that is closer in the beginning, at least, you can mitigate those risks and those trade-offs of the target choice. So this is the 4 or 5 examples, and I hope this gives you a little bit more context to the daily bias, and it helps you implement it more in your trading. Now let's take a look at how I organize my charts, how I plan the trades, and how I approach the live markets. So as you can see, I'm using tradingview.com for my charting, but it is not mandatory. You can use any charting platform that works for you. We don't need any advanced tools or anything. it will work on any platform. Just use what you are comfortable with. And I will just show you my workflow, and then you can see how to approach it and how it makes sense for you. So I'm always starting on a daily time frame. You can see here's the daily time frame chosen. And what I do is I have set up here my watch list, which is very easy in TradingView. You can add different lists with Forex pairs. You can create one with indices from all around the world. I have one with the S&P. I had one with the DAX, which I need to re-add now. And you can see, you can Google for, and you can add new ticker symbols very easily. So for example, let's assume you want to create a new list. Let's say we want to create a DAX. And now you have a new list. And when you want to add a new instrument, it's very simple. You just go here and then you can type in whatever, BMW, whatever you want to have, and then it will be added to your list, and then it will be here. All right, let's go back to Forex. And it's a very, very simple screening process. What I do is that every day, every 2 days, I will go through my daily time frame one by one, and I will just use my keyboard to go through this. You can see it jumps through this when I just click my keyboard arrows. And this is a very, very quick and effective way to do your watch list. So what I do in the first run is I will go through all my markets just one by one. And just at one glance, I'm looking at, is there deceleration? Is the market either very extended, or is the market just doing a retest at a moving average? And if I see that there's one of those criteria present, that the higher time frame is good enough, I will just flag it. I will not go to the lower time frame yet. I will just do my first rundown and see, okay, is there something? And by the way, there was nothing. It's just to show you an idea of how to approach this. And then once I have done this, let's say I have flagged a few ones, then I will come back to the first one, to the top of my list, and I will go to the lower time frames to see, okay, is there actually something that is worth trading or not? And if there is, so for example, right now there's nothing here, but there was a daily bias here at the lows. You can see very strong downtrend, then here very small candle, and then here an engulfing candle. So this could have been your daily bias candle. And in TradingView, we can go to the lower time frames actually and see how the candle looks back then. So assuming that this is my watch list, this is how it looks on the day that I screen the markets. I will go then to my lower time frame and we'll see, okay, what do we have here? The 2 hour, how does it look? Okay, what do we have? Maybe we have a pattern in here. That looks quite good. Okay, maybe we need to change this color. So a breakout, we need a breakout above this level. Also, the moving average has to come down. So we need to wait for those conditions to be fulfilled. And I find it very helpful to draw it on your charts, because then you come back to it maybe a few hours, maybe a day later, and you will exactly remember what you were looking for. And then you can compare with if it has happened in reality. Another thing that is nice and convenient in TradingView is that you can set price alerts. So for example, if I want to set a price alert at this level here, you can just click on this plus icon wherever your mouse is, and then you can just add alert, and then it is created. Obviously, I'm now in replay mode, which it doesn't work, but in the normal live conditions, it will work. And then you will get alerted as well about something that is changing. So let's see what happens afterwards. We can follow the price action. Let's get rid of this for now. And you can see that the market is breaking the pattern, but it's not breaking the moving average yet. We could also go to the lower time frame even further. Here you already do have an entry probably, but let's see, the moving average structure is not great. So you can see the moving average really helps us to find the right time frame. The 1 hour is not good, the 2 hour is okay here, but the moving average hasn't been broken here by the price action, which you can see here when it loads. And then when we move forward, you can see now we actually have a real breakout. Your stop loss may go underneath the breakout area, maybe somewhere around here. And the target, you could choose it based on the 4 hour or the daily. Let's see what has happened afterwards. You can see the market eventually moved higher. We've seen it already on the daily chart. And the market, this is the Friday closing candle. So I'm doing this video now on a Saturday, and before the Friday close, there was a big news announcement and the market dropped back into your entry. And this is how it could look on your charts. And let's see what happens on the higher time frame. You can see the market almost moved back into the daily 50 moving average. Let's see what happens on the lower. The moving average on the 4 hour has been hit. And if you would have put your target on the 4 hour, you would have been in and out of the trade very quickly. If you are on the daily chart, you probably would have missed your target. And then you will be forced to exit your trade here before the Friday close. So this is generally how I would approach it. And I will just go through all the Forex pairs and see, okay, what do we have? There's no overextendedness here. Here we are quite overextended, which is good, but do we have deceleration? I don't think so. It doesn't look it looks a little bit messy. We have a strong trend, but not really deceleration. This is an inside candle. Maybe actually it kind of does. Let's see, what does it look on the lower time frame? What do we have here? Nothing really too spectacular. And to be honest, and to be really realistic, when you do your watch list process, you can see I have maybe 30 Forex pairs, but I will only have maybe 3 good trades every week. So when you do your watch list process, it's very common to maybe you only end up with 5 or 6 markets that you're flagged here. That is okay. You need to be very selective. Being selective is one of the most important things of being a trader. So here you can see now on the 4-hour time frame, this seems to be the right time frame. We have some violations of the moving average around here, but the trend hasn't really been starting here. You can see the market was more or less in a sideways range, and when the market really, or the trend really accelerated, since then the moving average has been respected. So the 4-hour time frame seems to be the right choice here. The daily time frame, I'm not super happy about it. Ideally, I would like to see maybe a pin bar here. So I don't think this will go on to my watch list going forward. But let's see, I will still draw my potential trading plans here. It can be either a breakout, it can be something like this, or it can also be a retest. But to make it not too confusing, this is the trade plan that I need. And I can follow up on this one, see what happens. How does the price action actually look like here in the real mode? You can actually put your price alert here. You can see it is updated now. And when the market crosses this line, I will get alerted. And then let's go back. We can just go skip through this, and you can see the daily process, the scanning process is very simple, because it should be very obvious when the market is quite far away versus when it's just hovering around the moving average. And in the beginning, I would recommend to only focus on those overextended phases. Those are usually the easier ones to spot. You can see here, no deceleration, not far away from the moving average. Here, the same. Here, the deceleration has already played out, which is actually a trade that some of the students took here. So you can see this is the deceleration, quite a distance away from the moving average. And when we go to the lower time frame, the 2-hour looks not ready. The market is too far away. So let's see, what is the right time frame here? This looks like the right time frame. You can see we had a pattern in here. The moving average was respected, the head and shoulder, the breakout, and then the market dipped lower. And so this would have been something from last week, which some of the students traded. You can see the market barely missed the 4-hour moving average, and it's not even close to the daily. However, you can see there seems to be an important level in here. The previous 2 highs both stopped here, so that could also be a reason why the market is stalling here. But since it is Friday and now it is Saturday, you would have probably also already closed the trade here on Friday night. You don't want to hold the trade. Let's assume really you get into the trade here on the lower time frame, on the 1 hour. Let's say you get in here on the breakout, which is the actual entry, and let's assume your target is the 4-hour 50. So it is here, and you are now in a significant profit, and there's only a little bit more extra to gain, but there's so much more to lose if the market turns around. So those trades, I would never hold such a trade into the weekend, because the potential reward, this little thing that we can gain, is much larger than what we could lose if we don't trail a stop loss. And having all this overnight risk and weekend risk is not worth having for this little extra profit. But right now you can see this trade, or this market generally, you can take out the alert. This is not a market that would go on the watch list, because the daily bias has already played out. We are in the middle of between the top and the moving average, so there's nothing here yet. And this is just what you continue to do. It's a very quick scanning process. So even though you follow a lot of markets, you don't need a lot of time. Here is something that is interesting, but not yet. The S&P is currently trading at his all-time high. Last week here, at the beginning of the week, there was a doji, and I was very bearish on this market, but the market and the pattern never was triggered. So we can highlight this pin bar, and the lower time frame pattern is really our insurance. Many traders would make the mistake to just short this market based on the pin bar, but obviously it's not strong enough. And let's go to the lower time frame. So this is the pin bar that we have seen on the higher time frame. The 2-hour looks quite like a decent market, and I had drawn, you can see this pattern in here, and my price alert is set here, but the price alert was never triggered. It was triggered here by this fake out, But again, our rule for entries is never mid-candle, so this is not an entry. And so therefore, this trade has never been triggered. I still may keep it on the watch list actually, because it still feels like there's a good chance the market will actually reverse, especially given this all-time high situation. So I will keep this on my watch list. I will go to the lower time frame, redraw my levels, make out my trading plan, which should be very straightforward, and then we'll see. And this is what you do for everything here. And you can also do this then for the indices if you are interested in trading indices or just following them. You could have your daily bias. You can see there was a very nice daily bias on the DAX, very strong move here. And then suddenly you have a doji and then lower gaps. And you can do that also if you want to trade with a weekly bias, for example. You just mark your weekly time frame and then you can just scroll through them and see, is there anything that is worth trading right now? And again, most of the time you will not find anything worth trading. And this is the goal of this strategy. You want to be very selective. And all of those tools, the daily bias and the overextendedness, are all filter tools. Filter tools are very important to help us differentiate between markets where we don't have an edge and markets where we actually do have an edge. So don't worry if you don't have a lot of things on your watch list. Only 2 or 3 good trades in a week, that's all you need. There's nothing more that you need. So here, for example, Accenture, it's trading, this is the weekly time frame. So for individual stocks, trading the weekly higher time frame may be something to look into. You can see we already did have a bearish bias here with an engulfing candle that did sell off into the lows. And now you can see the market is coming back here. So maybe this would be something to actually look into further. Let's see how it would look on the lower time frame. Not too great, but we don't need to go all the way from the weekly to the 1 hour. That would be a little bit too much. But let's see, on the 4 hour, we have nothing. On the 2 hour, the price probably too far, yes, away from the moving average. So the 1 hour is actually the right time frame here, interestingly enough. And you have a trend line here. You can nicely estimate that, okay, we have this lower highs. And if the market doesn't really break the highs and it breaks below that, that's where I would get interested in trading this one. So maybe something to look into. And again, we can go back to the next chart and just keep doing what we've been doing and just find interesting markets. And we can do that for all the pairs here, obviously, and the markets. You can use any stock market. And then once you have done your analysis and once you have done your market preparation, you have this feature here in TradingView, the red list. Then you see everything that you have flagged, which is very, very interesting. Or you can go to your alerts here. You can see all the alerts that are currently active. Here are the active ones. Here are the ones that have been triggered. So there are many ways how you can keep track of your watch list. And that makes your weekly trading much, much more effective. What I do when I trade the weekly time frame as my higher time frame, I will only do this scan once a week, obviously. So every Saturday or Sunday, I will go through the weekly charts. If I have the daily chart as my higher time frame, which I do for Forex trades, then I will repeat this process once every day, at the end of the day usually, and when the candle is closing. But again, you can see with some experience, you can very, very quickly tell if there is a daily bias or if the higher time frame is not really according to our rules. And that's pretty much how I approach my trading. There are many ways how you can organize yourself with whatever trading platform you use. The most important thing is that you find something that works for you. Another caveat, in the beginning, it will probably take you a lot of time to do your watch lists, which is quite normal, but you will get used to this. You will get faster with time. Trading, and especially the way we trade technical analysis, is completely based on pattern recognition. So your mind and your brain will take some time to really understand what you're looking for. But after a few weeks, you will be very, very quick with your weekly scanning process. So don't worry if it takes a lot of time in the beginning. It will get better over time. You will get faster. And then this routine will help you actually save time. You do the daily scan once a day, and then you know exactly what you're looking for. And then during the day, you don't need to worry too much. You know exactly what has to happen in order for you to get into a trade. And then you can save a lot of time during your trading day. Good morning, good morning. Mods. Moin. Yeah.
Ding dong.
Good morning.
Good morning.
Warte. Make host. Oh, you don't have to be a host.
Yeah, but I cannot start the video.
Oh, okay. Warte. So. No. Yes. Good morning. Good morning. Oh, on the weekend it's time shift. This will be hard. Hi, Edward. Good morning. How are you? I already saw there was quite a good discussion going on.
Is it the red pill or the blue one?
Depends on the time of day.
You know what I'm gonna do about the time zone shift?
What?
I'm just gonna fly to Asia on Sunday.
So it's even more screwed up.
But
This Sunday?
yeah.
Okay. Okay. Hey, Jason.
Good morning, Nicholas.
So let's maybe wait 2 more minutes and then we get going. Nicholas, hey there. Oh, and then tonight, in the afternoon, I have my webinar. I think there's been quite some moves. Will be interesting. And now I don't even miss coffee anymore. I think it's been 3 weeks. It's really cool.
Federico, good morning.
Hey, Federico. How are you?
Enjoy your week off from trading.
Almost. That's great, Edward. Yeah, I now always drink matcha. It's even better than coffee after a while. Okay, should we start?
Yeah.
Okay, 1 second, I don't see anything actually. All right, so the idea is that we want to provide you a framework and some guidance with the following questions and primers to help you write down your own trading business plan or strategy plan. Well, just ask yourself, would you think that a company or a businessman has any chance of success if he would just show up every morning randomly, unprepared, and just try to figure it out every day? Probably not. So it's really, really important that you have some guidelines, but it's also very important that, oops, let me move to the second, that this is a document that you look forward to. It should inspire you, it should be fun to review it, and it should just motivate you. As I said, it should provide guidance, because in the end, the business plan is something that maps out every little piece of your trading. It helps you also become aware of missing pieces when you do it the first time. It removes uncertainty, which I think is one of the the things that will help you make very big progress, because, well, it helps you then gain confidence, clarity, and deal with other shortcomings. And it's a step towards professionalism. You can tell quickly if, well, if a business doesn't have a business plan, it's tough. If a trader doesn't have a trading plan or a trading business plan, it's also very tough to make money.
Agree, yeah. And how do you, can you go back one slide? Yeah, so something that makes you look forward to trading. How do you do that in detail, for example? In my opinion, you should have some pictures of your future goal, for example, or of your AAA trades, because it feels really good when you take one of those AAA trades and you make a lot of money. And so what I have in my trading plan is simply a super awesome picture of a super awesome house, and basically things I want to have in my future life. And I look forward to that when I need some motivation in my trading, because sometimes you just don't get a trade for a week or two, or you only get shitty trades or some break-even trades, you lose motivation, and then that always helps to remind you why you are actually in the game.
Yeah, you can, and you should, I guess, add pictures, use nice formatting, and just create a document that you can enjoy actually pulling up.
Yes. So the bigger picture, define your why. Yeah, that's also, as I just mentioned, you need to know why you are in the game. And there's this super cheesy saying, if you know your why, you can deal with any how. It's super cheesy, but it's pretty true. And if you don't know your why, you will give up at the first hurdle, because you don't know why you're doing this, who you're doing this for, and you don't have a vision. So there's nothing to work for. So where do you see yourself in 2, 5, and 10 years? You should very clearly define this. One of my favorite authors, he says you can plan 15 years ahead. He's a Japanese guy. But in my opinion, 5 years is, for me, the best timeline, because so many things can change in 5 years. It's ridiculous. Your whole life can change in 5 years, and will, if you keep working on this. So yeah, I mostly plan in steps of 5 years. What is my lifestyle now? Where do you want to be with my lifestyle in 5 years? And then you upgrade your lifestyle and you plan for the next 5 years. That's how I do it mostly. How does trading fit into your life vision? Super important to know this, especially also in relation to your trading style that you are trying to achieve. Do you want to only trade 2 to 3 hours a day and then still work your day job, use trading as a supplement, or simply do nothing and only live from trading a little bit? Do you want to be a day trader? Do you want to go into the Hall of Fame of trading and make 1 to 2% every day and scale up super quickly? All that you need to define very precisely, because otherwise your trading style and your goals are not going to match. So yeah, maybe right now you have a lifestyle that only allows for one trading style, but once you go full-time trading, or if once you are profitable, you can maybe choose to move into other trading styles as well, simply to diversify and also make it fit your life vision. What career do you want to have in trading? Super important as well, in my opinion, especially for retail traders, because most people, they go into retail trading and they think they have to turn $100 account into 50 million, which is bullshit. There are tons of careers in trading that you can do, from working for a broker, join the dark side, to becoming an analyst in a fund and working your way up there. You can stay a retail trader forever. You can join a prop firm. You can open your own prop firm. You can also become an educator once you are profitable. You can do copy trading and try to gain a huge following there. So whatever you want to be, you have to be very specific about it, because there are millions of careers in trading, just as there are millions of trading strategies. Yeah, so that's super important to know as well. And what does profitability mean to you? So that's basically defining, is 1% per month profitable to you, 2%? What drawdowns do you want to endure? In my opinion, if you make 2% per month, you are making compound 30% per year with a drawdown of, say, maximum 10%. That's world-class performance, and that is profitability to me. 2% per month and more is what I'm shooting for. So, yeah. How do you define that for yourself, Rolf?
Yeah, I think the most important point about this one is that you stay realistic, because of course, I just yesterday tweeted again the statistic that 99% of everybody loses. But I think they're all, or many people are chasing wrong goals and have wrong ideas about this. And many traders could be profitable if they opt for 1 or 2% a month, but they want 1 or 2% per day, or well, before breakfast even. And this is creating a lot of issues, that if you have the wrong idea of what you're actually after, then you will never get there. By the way, if you have done the psychology course regarding the definition of your why, there's one exercise in there where we also go into this a little bit, and I said, okay, ask yourself what it is that you want, and then most people just come up with the money. But then you ask yourself, okay, why do you actually want the money? And then you come up with, okay, I want to provide for my family, or I want to have more freedom. And then you ask yourself again, why do you want to have more freedom? What does this actually mean to you? And then you suddenly get to the core of what it is actually that you want. And those things are usually more inspiring than just those surface level things.
Yeah, I'm reading this book right now. I have read, I'm rereading it, The Money Illusion, and it touches exactly on that topic, that everything we do is related to gaining more money because we think it will give us security or confidence or whatever. But in the end, money won't give you anything. So you have to be much clearer on your goals besides I just want to get rich. Because also, once you reach that goal of becoming rich, whatever that is for you, and you don't have any deeper philosophy behind it, you're going to fall into a very deep hole. Because now you reach your goal, but you're still unfulfilled. So what's going on here? Yeah. So I recommend the book Money Illusion. Really good.
Yeah, he has a great podcast as well. I think I posted it once. By the way, regarding the point with live vision, when I was living in Thailand, I met an expat from the US who was living on one of the islands, and he was also trading, but his live vision was so different. He said he doesn't care about becoming super wealthy. He doesn't need a Ferrari. His lifestyle was really, really inspiring. He was day trading the US sessions a little bit, and he was into longer term investing, but this only took him around 3 hours per day, and the rest of the day he would just go surfing, and he would hang out with he had his family in Thailand as well, and he had, I think, one of the most relaxed lifestyles that I've ever seen. And this was just very inspiring because while he's in Thailand, he doesn't need too much money, and he just figured out his why, and it is surfing, taking care of other hobbies, and just having time for his family.
Yeah. And that also brings me back to that what Van Tharp said. So working 2 to 3 hours per day is basically passive income. And he said, so if you can make enough money to have a great life with 2 to 3 hours per day, and you still want to work more, then you have to ask yourself the question, why? Probably because you feel insecure, and you think if you don't work much more and harder, you're going to lose everything. But that comes from a totally different place. That doesn't come from that feeling doesn't go away with more money. It will just intensify the more money you have. So Edward says, no one is ever going to create a lifestyle on a 10K account with 1 to 2% a month. Yeah, that's true. Low account size must have higher risk. I partly agree. So if you think that you have to scale up on this $10,000 account, then yeah, you should take higher risk if that is your only means of income. But I think for 99% of people, it's not. You can always cash in more, for example, from your savings, from your job. Every day, every month you have a profitable month, just cash more into that account, sell your car, sell your house, I don't care. So it's much better to increase your account size than taking on more risk, because it also creates bad habits. And if you cannot do that, then simply go for services like DAOinex, for example. Find other people that invest in your skill as a trader. Make your wife work harder and live from her salary. So there are always options. You don't have to take stupid risks to scale up an account. That's just an illusion, in my opinion. Nicholas, is the big book from Irving Fisher? No, it's from Cease Kyle.
Yeah.
Cease Kyle.
He used to be a comedian, I think.
Yeah, he was a comedian and then motivational speaker. Kyle Cease, yeah, exactly.
All right, so the next slide, it's about communication and your personal surroundings, which obviously can have a very big impact on you. Ask yourself, does your family and significant others support you? Well, it depends a little bit also on the culture. For many, they don't. But you can, or you need to get again to the why. Why is that? Do they have maybe a bad idea, or they don't really understand what it is that you're doing? Maybe they think you're gambling. And if that's the case, you can educate them to some degree. Certainly, my family was not the most supportive in the beginning because they just didn't understand what all of this was. But when you communicate it the right way, then often you can create a better positive and a personal surrounding around yourself, which is very important, obviously, because those people, even if you tell yourself, "Oh, I won't let this get to my head," it will, obviously, because those people are often very close to us, and other people's opinion do matter to us. Define yourself. Who are you? Who are you? Look beyond trading. Trading, you're not only a trader. Trading should just be a little bit of what you're doing, actually. Trading is an activity, but trading should not be everything that you do. And if everything in your self-worth is attached to trading, and if you define yourself as a trader, then if your trading doesn't work out, or if you have a bad time, this will really bring you down, because then suddenly you have nothing else, and your whole identity seems to go downhill. So really think about what are your ideals, how do you see yourself in the world, who are you, what are your other interests, and all of that stuff. Clearly transport the message to the outside world after you have defined it for yourself inside. Lead by example, very, very important. And yeah, show everyone you mean it. This is, I think, what helped me in the beginning. People would doubt me because, well, I didn't have anything to really show for. But then I showed them that I mean it, and then results solve everything. So once you have some results, then people will suddenly start to accept it. You don't need acceptance, but it's nice to have at least a good, positive support group around yourself.
Definitely, especially your spouse and your parents. If they are not behind what you do, it's gonna mess with your head 100%. So you either have to solve that conflict, or you have to show them, yeah, that you are serious about this. And a business plan can help with that, of course. Show them your business plan, which is probably going to be 50 to 100 pages or so. with setups, how you want to scale up, how you want to approach things. It will make your point of view or your standpoint much easier. It's like you convince a bank when you bring a business plan to them to give you money. And yeah, if I'm pretty sure if you convince them a year later or so, when you're profitable, they will come to you and ask, "Hey, can you turn my 1,000 into 10,000, please?" It's not like that never happened.
And this could be also, by the way, in the bigger picture, that you want to get to a point where you can make 5% or 10% a year, and you can help your immediate family or other people to find better investments, instead of just having sit their money in a bank account where they don't earn anything. You can help them a little bit out, and this is also, you don't need to make 100% a year for that, but just anything above the savings rate is often everything what people want, and it can be a really big why.
Yep. All right, tools. Tools are important to define because otherwise, same as strategy, jumping, you will just jump around with tools and lose a lot of time. I did this a lot in the beginning. I was testing different trading softwares and so on. And in the end, none of them give you an edge. You just have to stick to one and get used to it. And then, all you do with the trading software is to put in orders, and that should be all it does. So which broker are you going to use? Also, do your research. Don't use any broker that isn't properly regulated under a body that is, in a first world country, I would say. None of those sketchy islands, stuff like that. Which software do you use? Which hardware? In the beginning, I had my laptop, and I still trade mostly off my laptop, to be honest. But when you are at home, one or two monitors helps to make your workflow a lot better. And if you define all of that in your business plan, then you simply know what you want to use and what you stick to. Anything that automates and makes your life easier is good. So if you can write some scripts in any trading software, can do that. From MetaTrader to TradingView to Interactive Brokers, they all have an API or something like that, which you can use to write scripts, maybe to scan for your trades or to send alarms to you or to automatically manage your trades, stuff like that. That makes life a lot easier and also frees up brain capacity. And outsourcing, for example, if you're a longer term trader and you want to do some fundamental analysis, it takes a lot of time to fundamentally analyze a country or a company. It takes like at least 30 minutes to an hour if you want to do it really in depth. And this takes a lot of time. So think about outsourcing, subscribe to global macro newsletters, for example. And there are some really good ones out there. Danske Bank is doing a great job, for example. And you can pay a few bucks and save a lot of time. And you can put that into your strategy and into refining your skills. So in my opinion, outsourcing is one of the most powerful skills that you can use in any business plan, because as long as you do everything yourself, you will always hit a ceiling and you won't grow from there. Outsourcing is a huge one, and automation as well.
I think the most important is also here that you don't get lost in this. You can easily spend or waste weeks and weeks on testing different softwares. If you're a technical trader, obviously you don't need such a gray or crazy infrastructure. And also you need to make sure that your priorities are set correctly, which should be at becoming a better trader and not trying to set up like a tech haven in your office. So really get to the core of this, I think, in the beginning. Make sure that everything runs smoothly and then focus on your trading, but really be clear about the tools that you use, so you don't jump around, and really make a commitment.
Yeah, I've seen people procrastinating by switching from software to software. And the other day, I even got a private message on Instagram there was a guy asking me, should I hunt for real estate now to set up my trading office? And he wasn't even profitable yet. I mean, what the hell is going on in the minds of these people? It's horrible.
Yeah, and you could easily lose. Yeah, I get messages all the time on Instagram, which is also the reason why I left there. And it's just people, they just always focus on the wrong things. I have some people who hunt for the best broker. They want to know what are the best specs that you need for your trading. And this is, yeah, it's procrastination. You just try to avoid the real task at hand. It can be a really, really big issue, and you need to ask yourself then, why is it actually that you're trying to procrastinate? What are you scared of facing? And yeah, this is usually a much deeper issue.
Yep.
All right, so let's get to a little bit of the technical stuff. Now we have cleared the surroundings. So for each setup, you need to make this separately. You need to define each individual setup, and you really need to have a very profound and very in-depth idea of what the setups mean, how they look, and what really makes them up. So what is the idea behind each one? And for example, let's start with a head and shoulders, for example. What does it tell you about the market sentiment? What is the structure meaning? What do the changing highs and low mean? What is the break of a neckline mean? Really understand and create a story around this. I find this very helpful, because then once you are at the charts, you can look behind the price action, and you can really understand, okay, what is the market telling you? And it makes the next steps also much easier. During which markets do the setups work best? So what are the criteria, or what are just the conditions? Do you need a trending market? Do you need a very volatile market? Do you need a calm market? Do you need a market that moves a lot? Do you need a range market? Just ask yourself that. And then find at least 3 to 5 screenshots of your perfect trades regarding each setup, and write down the trigger criteria. So last night we talked about this over dinner, that I wanted to create a checklist, but I was not really sure of how to approach this, because everybody sees their trades a little bit differently, and everybody has a little bit of a different idea of what they're looking for. So this is, I think, a much better exercise for all of you, because it really forces you also to think about what is it actually that you're trading, what is it actually that you're looking for. And if you have 3 to 5 screenshots of really good trades, they really fit all the criteria, or they really look good on paper, first of all, regarding the setup, you can just write down the things that they have in common. And it really forces you also to finally think about what the setup is. When you look at all those retail traders on social media, in other forums, they have a very shallow idea of what they're actually looking for. They want to have a pin bar at a support level, but what does it really mean, and what are the surroundings that they want? So find a trigger criteria, candle size, it could be a breakout. Later on, we get into how do you really define the technicals, what is really a pattern made out of, and really try to look for similarities in the best trades. What separates a great from a not so good setup, also very important. And then you can create checklists. Obviously, in the beginning, this will be a little bit not as smooth, but with everything, just the whole trading business plan thing is something that you can grow into, that will evolve over time. It won't look the same now as it will look in 2 or 3 years, or even maybe in 6 months. You will learn more about yourself, about your trading, so it will evolve with yourself. And also define it. I really underline individual setups, because in the beginning you should be clear about, okay, what are really the setups that you trade. I understand that in the course I have many different patterns, but if you have some issues with consistency, then I would really recommend, as we did it with Michael, for example, to really pick one setup in the beginning, try to really master it, and it will also force you to really think about it. And this thought process you can then use for other setups as well, but really pick one, or if you have a good understanding, then maybe 2, and then scale up from there.
Agree. Yeah. And then for the second part, how many setups are you going to trade right now? That's super important. Focus on one setup in the beginning, master that, and then start adding new setups. As I said before, right now I'm trading 7 setups, but I added them like maybe one setup per year. So it takes at least a year to master a setup, probably more, but after a year you can trade it more or less on autopilot, and you know exactly what you are doing, what you're looking for, you know the nuances and so on. And that's when you free up brain capacity and you can start adding new setups and start reading new books or get information from other sources and start developing a new thing, or maybe start developing it on top of what already works for you, which is what I do a lot. So for example, I have a setup now which I trade with the pullback. Then I notice during the last year, at the end of the year, I do a trade review of all the trades I missed, all the trades I took. I noticed that there are some trades I'm missing because some criteria are different than the trades I'm already taking. So I'm starting to try to implement a new setup around that and so on. So that's how your strategy organically evolves and makes it, grow with you. Make your setups grow with you as a trader, and don't put on like it's like trying to drive 10 different cars when you're just starting out as a race driver, for example. When will you add new setups? What are the criteria? Yeah, for me, the criteria were always, I want to master this setup first. I want to be consistently profitable with it. I want to be able to trade it on autopilot. And once I feel 100% confident with this setup, I don't need to do any more back testing with it. I know exactly how and when and where I'm going to trade this. That's when I can add new setups if I want to. I don't have to. I can also just trade the setup for a year and chill and consolidate what is going on in my brain, which last year I did, for example. I simply consolidated. I didn't add any new strategies to my funders because I was happy with it. And now I'm starting to add new setups again because I'm again hungry for knowledge. That's also something that's super important. And which setups do you plan on adding? Yeah, as I said, why? For example, why could be diversification. Super important is that they don't contradict each other. It's not as simple as many people think to trade different setups, because suddenly you get different signals, or one signal for one strategy seems to be developing, but the strategy of the signal of the other strategy already triggered. So what do you do in those cases? And it's super important to have different to have a rule set for that. If you have contradicting setups, I wouldn't even, to be honest, I wouldn't even do that in my trading plan. But if you have setups that, for example, stop loss of one of your setups gets taken out, and then you can observe very often that if the stop loss gets taken out, market just explodes into the other direction. So that's how I developed one of my other setups. When I get taken out, I can reverse and get in with certain conditions. And that's something that's not easy to do, because it takes up a lot of mental capital. You have to be very clear and focused because you just took a loss. You have to be very careful that it doesn't turn into revenge trading. But yeah, it's much easier to trade setups that complement each other. One simple example of that could be, if you are an Elliott wave theorist, you want to have one setup that gets in as a reversal setup. Then you want to have one setup that trades the third wave and one that trades the fifth wave. And then you go back into a reversal. So that time you have 3 setups, two trend following, one reversal. And that's how you could have 3 setups that complement each other. And they are all based on the same theory, Elliott wave theory. So that could be one idea to do it. And why do you add setups? Well, that's the question you have to answer for yourself. Do you want to be more diversified? Do you want to have more trading opportunities? Do you want to be busier? And do you feel lazy? that's something you have to make out with yourself.
You said one interesting thing, the point, what are your criteria? And then you said, once I'm consistently profitable. And again, this comes back to the first slide, that you really need to define what is profitable. Otherwise, most people will have the same answer, but they don't have the definition that you probably have for what is profitable for you. And then what happens is, again, you have a lot of uncertainty. You don't really know when to do that or how to do that. What is really profitable for you mean? You just make a lot of money. And again, the more uncertainty you can remove from your trading, it frees up mental capital or capacity, and it can remove uncertainty. And uncertainty is really, really a really big issue that you need to overcome.
Yeah, exactly. I mean, profitable could also be that for the whole year you are break even, and then at the end of the year you just make one trade and you are plus 1 hour. Okay, you have been profitable for the year, but it's not really profitable.
And most traders have the problem that they define profitability as making 200% a year. And then obviously they never reach it, although they could be so close to having a more realistic profitable goal.
Agree. So Edward, this is great advice, guys. This was one of my problems. Now I focus and own one style and setup, then I will grow. Yeah, exactly. That's how you should do it. Ling, could you chat a bit more on the career timeline with this topic set up? Say we started a profitability journey with one setup after years of mastering, then move on to the next setup, another learning curve, takes up dollar capital again. So then when will the career become profitable? Okay. Yeah, so you shouldn't, I mean, we are not entrepreneurs in the traditional sense that we take profits out of one business and we put it into a business that is not yet profitable. Ideally, a new setup. So if you have become profitable with one setup, you already know yourself psychologically. You already know what works for you. You have to have decent chart reading skill. You have to have decent environmental skills, risk management, and so on. So adding new setups to your already repertoire won't even be 20% as hard as the first setup. Once you're profitable with one setup, at least for me, it was super, super easy to develop new setups and to trade them consistently. So don't think that adding new setups is like burning money and dumping money into an unprofitable venture. That's just not the case. Just backtest it, forward test it, start with a small position size with the second setup, and then slowly scale up. You could use only 0.1% or 10% of your actual position size on the new setup. And then, yeah, as you become profitable, you collect data and so on. You simply go to full position size slowly, and then you have two setups.
And often it's also, as you said, it's a natural evolution. You start with one setup, and then, but only if you have done really the work behind that, before that. You often notice little variations, you notice things around the setup happening, you maybe notice something that happens after the setup, or you maybe see setups that don't fit the criteria, but they are interesting. And then you can start developing new ideas around what you are. And then it's a very, very natural process usually.
Yeah. Edward, profitability percentage when annualized can be tricky for a trader. A 50K account can be traded and pay for a comfortable lifestyle with weekly withdrawals. And each week the account is 0 to 50K again. Annually is grown 0%, but provided a nice, easy lifestyle. So yeah, well, you don't want to take out that much that you don't grow. That's another thing. So you definitely want your account to compound, and you only want to take out as little as possible. And what I do is that I pay myself yearly, not monthly. I make a yearly payout from my trading account, put it on my on a separate bank account, and I pay myself a monthly salary from that divided by 12. So if you pay out, I don't know, 100,000, you divide it by 12, you pay yourself 8,000 every month, and then the next year you do that again. And by doing it this way, it's much easier to psychologically overcome short-term drawdowns, hurdles, and so on. Don't put too much pressure on yourself. And also always make sure that you can compound and grow your account. Don't pay out so much that you cannot grow your account, because that's the ultimate goal, to grow your account to a level where 10% per year can pay for you and your family and everything else.
I think this is also something that would come up in the beginning. What is your 2 or 5 year plan? If you notice that you have no money or you have no way of growing actually, that every end of the year you're back to square one. This is also a very, very fragile way of just designing your life and where you want to go.
Yeah, if you pay out monthly, it gets kind of tricky. If you don't perform 1 to 3 months, puts on too much pressure, says Konstantin. Exactly. That's the reason why I have annual payouts, not monthly payouts. I do, however, reward myself. If I have a huge month, I will take out a grand or 2 grand and buy something stupid with it and be happy.
Yeah, so again, this is one of the issues you have with social media, those people who always withdraw everything. It's just everything what you see that is really not setting you up for the right way.
Yes.
Okay, setup parameters more. So once you have defined the core of a setup, you need to look at the technicals a little bit more. So how do you place stops? This is something that we have seen in the webinars quite often, that people are a little bit uncertain about this. And in the beginning, obviously, you probably won't have the best or the approach that you will end up with like in 5 years. But you really need to be certain, and you really need to have a good approach or a set approach that you know, okay, how do you place your stops? How do you protect it? Do you put it behind the breakout point? Do you only need the breakout point, or do you need another barrier? And what is it actually? Do you use always a padding? So do you add some space to each stop loss? How much is that? What is the rationale behind it? Why do you do that? Very important also. Instead of saying, okay, I just put my stop loss behind the line and then we'll see. You want to protect it, and what is the idea? The same is true for targets. Which tools do you use? Do you use technical tools, or do you use the fixed target approach? What is the resulting reward to risk ratio out of that? What is the reward to risk ratio that you require? Is there a minimum cutoff point? What does it mean for your win rate? So the way you choose stops and targets obviously also influence your win rate. If you have very wide targets, the price will have a harder time reaching your targets, so your win rate may drop. But on the other hand, your reward to risk ratio will go up. So ask yourself, is this something that you can deal with emotionally? We had a discussion, I think yesterday or 2 days ago, that some traders do prefer actually a lower reward to risk ratio and a higher win rate, because they want to have more positive feedback. Other traders, they approach it very differently. This is where I'm going more and more. I don't care too much about how often I win. I want to have big winners. And this is also a gradual shift, but you really need to be clear about how you want to design and set up your trading environment. And again, this is not something that if you write it down once, you have to stick to this forever, but at least you have clear principles. And then only if you have done the work, then you can come back and really analyze, is this really something that works for me? And if not, you can make changes. But if you haven't written it down and you make changes, it becomes very, very random.
Yeah, and also what I cannot overstate in importance is not only the emotional profile of your risk reward ratios, but also of the time frame. In my opinion, everyone has an emotional time frame. And if you hold trades for longer than a day or 2 days, 3 days, it can require a lot of mental capital from some people, especially if you have to hold through pullbacks. And you have to be very clear on that, in my opinion. So in the beginning, it was super, super hard for me to hold trades through pullbacks. So I would go mostly for one-to-one trades and get out super quickly. And now I'm getting better at holding trades for longer time periods. But in the beginning, it would have destroyed me to hold a trade for 3 days. And then it would drain so much mental capital from me that I would not be able to trade for another week after that trade. So yeah, be super clear about your emotional time frame.
Yeah, and then it feeds back into everything I have. I have a Windows laptop here next to me, and it is always, I always turn it completely off. It's completely turned off, and there is my trading platform is only on this Windows thing. So if I want to make a trading decision, I need to reboot it. I need to log in. I need to open my trading platform, and then I need to do whatever I want in the trading platform. So this gives you a little bit of a buffer between your impulse decision when you look at your charting platform. Oh, I need to move my stop loss. I need to add to the position. But you have at least like 20 or 30 seconds of thinking time, and you will often realize, okay, what I'm about to do is really not what I should be doing. So this is, again, it comes back to emotional profile, the time frame, the holding time that really fits to you, and also setting up your technical surroundings.
Yeah. Set yourself up for success.
And you get to know yourself in the process as well, which is very interesting.
Yeah. Strategy definition. Yeah. Which time frames do you trade? That mostly relates to, as I said before, your emotional time frame, also your lifestyle goals, and your current lifestyle. So yeah, if you're working a day job, don't be a day trader. Edward, ability to hold a position through pullbacks is directly related to risk size, I have found. Okay, that's interesting for you. So the smaller your risk, the easier it is for you to hold, probably. Yeah. That's something you have to look deeper into. Or simply always risk less because it makes you a better trader. Okay, strategy definition. Which markets do you trade? Also super important. In the beginning, I would say stick to one market. Don't hop between, because they all have different quirks. They have different things you need to know, especially if you switch between forex and futures and stocks, and they are all chart related. But then you go into options, which are more statistics related trading strategies most of the time. All of that stuff takes away a lot of your mental capital. So which markets do you trade directly correlates to which strategy do you trade. And often you can apply a strategy to different markets, but again, master one setup first and master that on one market. Then you can decide to branch out to new markets or to add new setups. How do you manage your trades? Active versus passive approach. How do you specifically manage trades? So active versus passive. In the beginning, most traders 100% are better off with trading set and forget. And that's just what I have found out with mentoring people and looking at edgewonk databases and so on. Everyone messes up trade management. Everyone. It's horrible. And there are even broker studies that showed that 60 to 70% of retail traders can predict short-term market movement positively. So if they would always trade for one-to-one, for example, set your stop below the last swing high or low, they would make money if they went for one-to-one. But they mess it up with trade management and stupid take profits somewhere in the middle of nowhere and all that stuff. So yeah, be careful what you do with your management. In the beginning, simply trade set and forget. And while you trade set and forget, you can test different trade management strategies, for example, with edgewonk as well. Simply when the trade is done, look at how would I have done if I had managed this with the 50 EMA, or if I had gotten out at the first pullback, or if I had gotten out at the trend change, or if I went down to the 5-minute and looked for reversal patterns, blah, blah, blah. You can test whatever you want. And then you will quickly find that some active management strategies are going to perform better than set and forget. But then you still have to implement them correctly. So you have to have zero emotions while you're in a trade, which is also very hard. And you have to define that. You have to define that super, super clearly. How do you specifically manage trades? So I'm getting into this trade. It's a short trade, and I'm getting out when there's a swing high and that swing high gets broken with a close of a 1 hour candle, period. And in any other condition, you don't get out of the trade. That's how you specifically define how to manage a trade. That's just an example. But you need to have those rules 100% down, or you're going to mess it up completely, and you are better off trading set and forget. That's my opinion on it. How do you deal with news? Most people stay out of news. I like news. They provide the volatility I need for my trades. In the beginning, if you're an inexperienced trader, it's probably better to stay out. But yeah, define that for yourself. How do you deal with news? And what do you do when you have a position on? What do you do when you have a potential trade coming up before news? Which news events do you want to look at? Which news events are not so important, and so on. And also, how do you define technicals? Super important. I see people trading trend lines and they draw them differently on every chart. So, or ranges. How did you define a level? How many hits does a level need for you to recognize it as a level? And is the level as an extreme? Is the level at inside price? Do you draw it at the closest? Do you draw it at the lows and highs? So you really have to define it, put some screenshots into your trading plan as well. So you know, this is how I draw trend lines, and this is how I do it all the time. I don't care about how anyone else does it. You just need to be consistent. Otherwise, you're going to be comparing apples and bananas.
Yeah, the last point, how to define technical, is very important. And this, you don't use, or at least for our strategies, you have a set rule of technicals, but you need, so it doesn't take too much time, but you really need to find it. When you draw a pattern, what are the definitions that you require? How do you, what do you accept as a support level? What do you accept as a boundary or a neckline of a head and shoulders, for example? All of those things you need to have down for. When you look for Fibonacci's, for example, what is an acceptable pullback? How do you want the price to snap or to respect a certain retracement? All of those things can be defined. And again, those are not set in stone, but at least they provide you guidance, and then you can adjust along the way. Risk is very important, obviously. So you need to define a few things here. What is your standard position size? Whatever this may be, it will be different for many people. Just because everybody says you need to risk 1%, you should not really just accept it without questioning it. Ask yourself really, what is it that you can deal with? Do you need less, maybe, like Edward said, maybe, or do you need more to just, because maybe your trading account is very small and you accept that a higher risk will be the way to go for you. Just be clear about this. And again, this is, it will remove a lot of uncertainty once you have identified a trade. You don't need to think, oh, how much should I risk now? And then you need to think about this, and then it screws up all your other processes. Suddenly you feel not confident anymore, and then it has, just a very bad chain effect. To use dollar or percentage-based position sizing, very important. How do you calculate your position size? Like Moritz said, if you use MetaTrader, there are scripts you can load into your MetaTrader, will help you with the position sizing calculations. Just be clear. You don't want to find out suddenly that you're about to pull the trigger and then you need to go to Google, Google how to size your position. Then you try to find a position size calculator, and then you figure out, how do I put in the data? So have it already. If you want to trade that day, have the position sizing calculator open, ready, and filled out, so that you can just focus on what is really important. What is your maximum open exposure? So how many trades do you accept at any one point in time? And how much is the maximum you want to have exposed at that point? Define it, really define that. Also, what happens is that when a trade moves into a profit, how does it change your open exposure? Are you allowed to add new trades or not? Really define that. And you don't need to get too, you don't need to make it too complicated. You want to have a very set rule, a very defined set of rules. There are people who will get very, very into this whole business plan approach, and they will write hundreds of pages. I've seen that, but this is often missing the point. Yes, you need to define certain things, but it needs to be actionable as well. This is very, very important. What is your maximum drawdown you're willing to accept? How many losses in a row are you going to accept before you go back to your trading journal and make adjustments? What do you do when it is reached? Do you scale back on your position? Do you maybe change your approach? What are you going to do? Do you take a week off, or what are you doing? How do you deal with correlations, especially in Forex, very important. We've seen it many, many times. People, even if they have been with us for a long time, they're just uncertain, and every time they need to ask again. There's a euro US dollar and there's a euro Canadian. They're very correlated at that point maybe, and then they need to ask, do I take both? Do I take one? How do we deal with that? And you need to define it once and for all, or not for all, but you need to define it once. Then you apply it, and then you can see, okay, is this really working out for me? But those are all the things that you can really define for yourself. And the more you can answer those questions, the better, or the more confidence you will have. And I can't stress this enough, this is not set in stone. You can change it as you progress, but you really need to define it at least in the beginning so that you have some guidance. Otherwise, you will just float around and you will be all over the place.
Yes, account growth. How do you plan on growing your account? That feeds back into what Edward said before. So yeah, how do you plan on growing your account? Do you want to take more setups? Do you want to take more risk? Do you want to trade other people's money? Do you want to go into copy trading service? And how are you going to add funds to your account? That's all things you need to define. And do you plan on adding to your account? Yes. How? When do you start adding? What are your profitability criteria? When will you stop adding? Also interesting. So for me, I kept adding and adding and adding to my account for every profitable month. Basically, I did dollar cost averaging on my own equity curve. I saw my equity curve as a stock, and I simply added every month to it a certain fixed amount from my salary and from my savings and so on. And then in the end, when that amount that I added became less than 1% of my trading account, I stopped adding, because what's the point? It's just one trade, and I used that money for other purposes. So in that case, it was very straightforward for me. And also what this approach does is that it makes sure that in the beginning you don't make 10 R in 1 month, and then you add money and then you lose 1 R the next month, and it completely wipes out your profits from the previous month. And that sucks. That's not the way to go with adding to your account, in my opinion. I would simply do it slowly but steadily, same as your account growth. You add money to your account. And yeah, you should define that in your trading plan. For example, you get your Christmas bonus from your company. And what are you going to do with that money? Are you going to add it to your trading account and lose it all in one trade? That could be horrible, because psychologically you worked the whole year for that bonus. You have to be very aware of what emotions are attached to the money that you are adding to your account.
In the end, it always comes down to the story that we create our own things.
Yes.
Goals and performance. This is the fun part. How do you reward yourself? Very, very important. And it doesn't have to, how do you reward yourself doesn't have to be tied to a money goal or performance goal necessarily. Obviously it can, and it's also nice, but it can also be things that you're just very, very confident or very satisfied about. Things you did well. Maybe 1 month if you used edge wrong, you didn't have a red tilt meter. You executed your trades very nicely. And what are you going to do about this? For me, for example, I have certain things, but I also have like a weekly thing, which is just at the end of the week, if I did everything right, then I will just have I will create a very nice Saturday for myself, where I just do all the things that I feel like doing, that I want to do, whatever this may be, go for a workout, and then maybe book a massage there and a nice sauna, then go to one of my favorite restaurants. Then the rest of the day I take off reading material or whatever, go to the park with my dog for a few hours, listen to a podcast or an Audible, and just create the life that you can look forward to. This is very, very important. Many traders, they get too stuck in their head, and then they really forget what it is actually that they are working towards. And in the beginning, obviously, you need to tie the goals to process-oriented things rather than performance-oriented things, because the performance in the beginning will probably be not as great. Although you can also tie it to, okay, if I at least break even for the month, I will do certain things. Or if I only make like 1% a month, and ask yourself, how realistic is it that you can make 1% a month? You're very, very selective. You try not to do anything stupid in the meantime. And 1% a month is doable. And people say, oh, 1% a month means nothing. But then ask yourself, if you start chasing like 5% or 10% a month or 20% a month and you lose it, wouldn't it be much, much nicer if you had just made 1% a month? Of course, it might not be the Ferrari that will show up suddenly in your driveway, but it will accumulate over time. And more importantly, it will also give you a lot of confidence in your abilities. And then it's a snowball effect from there. And then define process-oriented goals. They can be weekly, they can be monthly, they can be biannually, whatever. Define performance goals. Keep it realistic, please. That's very important. You don't want to put too much pressure on yourself, and understand where you are in the cycle of your trading career. Are you just starting out, or are you already a little bit more advanced? Then it can change as well. Timeline. Be accountable. But I think you want to talk about this one as well.
Yeah, so yeah, timeline is important to know that you are actually making progress. But in my opinion, timeline is more important when you look back. So be very specific about what you reached in that year. Look at exactly, for example, now it's soon December, you look back, where were you in January? So that's when time becomes super important. How much progress did you make in 1 year? But into the future, in my opinion, be very careful with goals that you set up, because setting up a goal like I want to be profitable in 5 years is it's limiting, because you could very well become profitable in 1 year. But if you give yourself 5 years, it will take you 5 years. So be very careful with time-based goals, in my opinion. I have stopped using time-based goals for 99% of what I'm doing, simply because one, if you put too less time, so say you want to be profitable in a month, that's way too much pressure. If you say you want to be profitable in 5 years, then it's going to take you 5 years, because you always take as much time as you are given. If you look at if you were in university, you had to write a thesis and they gave you 3 months. It took you 3 months. But the reality is that you sat down one night before and wrote it in one day. So you could write a thesis in 1 day. That's so yeah, be very careful with this. And what I have found, if I don't give myself time based goals, I am much more efficient, and usually I reach those goals much quicker.
But this depends also on if the processes during your daily life are really defined and set up. Most people, when they just coast through life and they don't really know what they should be doing, then they will never end up anywhere.
Yeah, for me, it helps with the manifestation. So I do a morning manifestation. I know exactly what I want to reach and where I want to go. And then I work on that throughout the day, but I don't give myself a timeline. And that way I can reach goals much faster, in my opinion. That's how I do it. It works wonderful for me.
Comes back to your why again, which is very powerful.
Edward, every discussion about money and risk and account growth has roots in repeatable consistency. Yeah, if you can trust the setup and have a degree of trust in the outcome, consistent trading results leads to nirvana, all else follows. Yeah, pretty much. If as soon as you have confidence into your setup and into your abilities, You can, I don't care, you can go up to 3% or 5% risk per trade. That's totally up to you. I mean, disclaimer, I wouldn't do that. But if you can handle it psychologically and your numbers are there, try it out.
Yeah.
I've seen people do it.
Yeah, and Konstantin said that 12% a year is top. It is, and if you compound it, it's even more than 12%. But again, it comes back to people have the wrong idea of where they want to be. Their only goal with trading related is they want to have $1 million at the end of the year. Yeah, but if you have the long term goal, you use maybe services like Darwinex. You understand, okay, that's really what the people want to see on those platforms. They're not crazy about making 500% before breakfast. But if you really have a solid approach, you can attract a lot of capital there.
Yeah, if you look at the top strategies, the ones that consistently make 20-30% a year, they are the ones with millions of capital. And 20-30% a year is realistic, to be honest. It's very possible with trading Forex on a daily basis.
I think we should make a webinar around Darwinex just to show the power of how much you could actually make because the top,
yeah,
they really do make good amount of monies from all the things there.
Yeah, and there are other platforms, and you can simply copy your trades to all of those platforms simultaneously and simply rake in the cash everywhere if you are psychologically up for it.
Okay, the last one, trading process. This defines what you do and when you do it and how you do it. So when do you prepare your charts? This should be very clear. For me, it is once on the weekend where I do my main analysis, and then during the week I update it. I make another bigger update on Wednesdays, but essentially every day. I don't do it in the morning. I do it a little bit later. I'm not a morning person. So thank you, Moritz, for dragging me into those 7 a.m. webinars.
You have to move back to Asia, man.
Yeah. So yeah, be clear about this. When do you update your charts? Important. How do you update your charts? So yesterday, I think I showed an approach that many people found interesting. So on Saturday, we set our price alerts, and then I will just go through the price alerts if they haven't been triggered and see, okay, what has happened since then? Do I need to adjust the price alerts? And then I will look at other ones as well. But you really need to have an approach that is well defined. Otherwise, again, you are just jumping around and just don't know what to do, when to do it. When do you journal your trades in your trading journal? Yeah, do you do it at the end of the day with a basic input? Do you do it at the end of the week with one whole session? But you need to really, really be clear about this. When do you take time to review your trades? Of course, important. Not putting in only your trades will be important, but also just having a review process. And again, those things, they are not going to take hours and hours of time, but just looking into your journal, and again, how do you review them? The questions that I provided last time are very important, and they provide guidance. Otherwise, you will just pull up your H1 and you just start looking at random things, but you don't really know what you're looking for. Yeah, so really know how do you review them, what are the key figures that you're looking for, and how do you make sure you learn your lessons. Once you have your review process, you know, okay, I'm going to look at whatever this might be. I look at my trade management graph, I look at my tilt meter, I look at my risk profile, and then what do you do with those findings? How do you implement them, or how do they translate into real world actions? Yeah, and that's the business strategy plan. What we wanted to do is that you can, if you are interested, you can, well, you should do this obviously, but if you're interested, you can send it to us anonymously, and we could do a session where we just talk about one of those plans, where we give maybe tips, ideas, maybe things that aren't formulated in the most optimal way, and it could also be an inspiration for other people how to approach that. Yeah. Questions, comments?
Cool. So yeah, Edward, if you want anonymously, if you want, we can also do it. put you in a spotlight. That's up to you guys.
Yeah, you can send it to me anonymously. However, to my email, rolf@tradesociety.com. I don't care, I don't care who it is from. Of course, there will be some personal things. Yeah.
Yeah, because a business plan is super important. Trading is a business. You should approach it as a business. It's a one-man business when you start out, and it can become many people business later on. So you need a business plan. Yeah, whose business plan might that be? All right, funny. Cool.
Awesome.
So looking forward to your submissions, and would be epic to see some of you guys really put in some work for a business plan. And also, Michael, if you watch this replay, it would be interesting to get your business plan as well, because you still seem a bit over the place sometimes, and that really helps you define your edge, your process. It will help you a lot.
Yes, it's a very, very important document that will just have a lot of clarity or bring a lot of clarity and therefore confidence.
Yeah. It will free up mental capital, which you can use for the important things like trading, technical analysis, and backtesting, adding new setups, and so on.
Yeah, like Jocko Willink said, discipline equals freedom. I found this very weird at the beginning, but yeah, there are certain things you just need to be disciplined about, because then they will free up mental capital and time in other areas of life. And this is just a very important concept.
Yeah. Konstantin says, I wasn't consistently profitable until I had a business plan. Yeah. Same for me, pretty much. No plan, no money.
Okay, cool. Nice. So yeah, if you have any questions, we can do a follow-up on this one. And otherwise, I will see you in 7 hours, 3 p.m. German time. So enjoy your day, and we'll talk later.
Yeah, thanks for your time, guys.
Bye-bye. Have a good one.
Safe trading.